Here's a question that keeps you up at 3 a.m. What even is money? No, seriously, you work for it, you stress about it, you dream about having more of it. But what actually is it? It's not just paper. That $20 bill in your wallet costs about 11 cents to print. A $100 bill costs the same 11 cents. So why is one worth 5 times more than the other? And it gets weirder. Most money doesn't even exist as paper. It's just numbers in a computer. You check your bank account, there's $1,000. But that money isn't sitting in a vault somewhere with your name on it. It's somewhere. Or maybe nowhere. It's kind of a collective agreement that those numbers mean something. Money is, fundamentally, a shared hallucination. We all agree that these pieces of paper and digital numbers have value, so they do. But the moment we stop believing, the whole system collapses. This has happened multiple times throughout history. Countries where money became worthless overnight. People using wheelbarrows, full of cash to buy bread, or not even bothering. The cash was worth less than the wheelbarrow. So how does money actually work? How did we get from trading chickens for grain to buying digital art for millions of dollars? Why do some countries' money work better than others? And why does your bank seem to have money when you need to deposit it, but never when you need to withdraw it? Over the next few hours, we're going to explore the absolutely bizarre, often hilarious, sometimes terrifying story of money. How it started, how it works, how it fails, and why understanding it is the difference between being financially literate and being, well, broke. We'll cover everything from ancient cowrie shells to Bitcoin, from how banks create money out of nothing to why inflation is both necessary and dangerous, from why the stock market is basically a casino, to why governments can't just print unlimited money. This isn't a boring economics lecture. This is the story of humanity's strangest and most successful invention, the thing that makes you go to work every Monday, even though you'd rather be literally anywhere else. Let's figure out how money works. Part 1. The origins, before money was money. Chapter 1. Barter was terrible, or why we needed something better. Let's start with a myth that economics textbooks love, the barter economy. The story goes like this. In the beginning, humans traded directly. I have chickens, you have grain. We trade. Simple. But this system had problems. What if you want my chickens, but I don't want your grain? What if your grain isn't divisible enough? I only want a little grain, but you want a whole chicken? What if your grain spoils before I need it? So, the story continues, humans invented money to solve these problems. Beautiful, elegant, simple, except it's mostly wrong. Anthropologists have searched for these pure barter economies. They can't find them. What they find instead are gift economies and debt-based systems. Here's how it actually worked in most pre-money societies. I give you chickens. You don't pay me immediately. You owe me. Everyone in the village knows you owe me because we're a small community and everyone knows everything about everyone's business. Eventually you'll give me something, grain, help building my house, whatever. The debt gets settled, usually without anything resembling money changing hands. This system works great in small communities. It breaks down in large anonymous societies where you can't trust everyone and can't track who owes what to whom. That's when money becomes useful, not to replace barter, which barely existed, but to replace complex webs of social debt that don't scale. But here's the thing. Early money wasn't what we think of as money. Chapter 2. Weird things that were money. Before coins and paper, humans used some absolutely bizarre things as money. Let's tour the greatest hits. Cowrie shells. These small, shiny shells were used as money across Africa, Asia, and even some Pacific islands for thousands of years. Why? They're durable, hard to fake, pretty, and come in standardized sizes. The problem? They're shells. Eventually, European traders figured out they could just collect massive amounts of cowrie shells from the Maldives and flood African markets, causing massive inflation. Turns out, when your money literally washes up on beaches, controlling the money supply is hard. Salt. Roman soldiers were partly paid in salt, hence salary from Latin salarium. Salt was valuable because it preserved food and was necessary for human survival. The downside? It dissolves in water. Try using salt as money in humid climates. Your savings literally evaporate. Giant stone discs. The Yapese people of Micronesia used massive stone wheels called rai as money. Some were 12 feet in diameter and weighed thousands of pounds. Here's the weird part. You didn't move them when ownership changed. They were too heavy. Everyone just agreed on who owned which stone. One stone fell into the ocean during transport and was never recovered, but everyone agreed it still had value, and ownership of the underwater stone changed hands for generations. This is important. The physical object didn't matter. The social agreement about ownership mattered. Sound familiar? It should. Modern money works the same way. Cigarettes. In POW camps during World War II and in prisons, cigarettes became currency. They're divisible, durable, kind of, and universally desired. But they have a flaw. People smoke them. Your savings literally go up in smoke. Also, inflation happens when the Red Cross delivers cartons of cigarettes. Deflation happens when they don't. Beaver pelts. In colonial North America, beaver pelts were legal tender in some places. You could pay taxes with beaver pelts. The problem: seasonal variation in quality, degradation over time, and the fact that the beaver population isn't infinite. Also, your currency could get moths. Grain. Ancient Mesopotamia used grain as money. It's useful, everyone needs it, and it's somewhat standardized, but it rots. Your savings have an expiration date. Also, good harvest? Inflation. Bad harvest? Deflation and starvation. Not ideal. Chapter 3. Metal changes. Everything, somewhere around 600 to 700 BC, several civilizations independently invented metal coinage. The Lydians in what's now Turkey are usually credited with the first official coins. Why was metal better than shells, salt, or beaver pelts? Durability. Metal doesn't rot, rust, much, or get eaten by moths. Your savings last. Divisibility. Melt it down, reform it. Make big coins, small coins, whatever you need. Standardization. Stamp coins with the same weight and purity. Everyone knows what they're getting. Intrinsic value. Gold and silver are pretty and useful for jewelry, decoration, some practical applications. Even if the issuing authority collapses, the metal has value. Portability. More valuable per weight than grain or salt. Easier to carry. But most importantly, metal money was harder to fake. Or at least, it required more skill to fake. You couldn't just pick up shells on a beach. The first coins were lumps of electrum, natural gold-silver alloy, stamped with a mark guaranteeing weight and purity. Revolutionary. Governments quickly realized they could make coins from cheaper metals and claim they were worth more than their metal content. This is called seigniorage, the difference between the face value of money and the cost to produce it. It's also the first example of government cheating the monetary system. Won't be the last. Chapter 4. Rome ruins it, the first major inflation crisis. The Roman Empire ran on silver coins called denarii. For centuries, the denarius was stable, trusted, and valuable. Then Rome started having money problems. Wars are expensive. Maintaining a massive empire is expensive. Bread and circuses to keep the population happy are expensive. Solution: make more money. But Rome didn't have more silver, so they did something clever and terrible. They reduced the silver content of the denarius. In 64 AD, a denarius was 95% silver. By 100 AD, it was 85% silver. By 200 AD, it was 50% silver. By 270 AD, it was 5% silver, basically a copper coin with silver plating. Everyone noticed. Merchants started demanding more denarii for the same goods. Soldiers demanded higher pay. Taxes had to increase to pay the higher costs, which required more money, which meant more debasement. This is a debt spiral, and Rome couldn't escape it. By the 4th century, Roman money was essentially worthless. People stopped using it. They went back to barter, or used foreign coins, or just dealt in goods directly. The lesson: you can't just make money worth more by saying it is. If the actual value, silver content, decreases, people adjust prices. Accordingly, inflation happens. Rome's inflation crisis contributed to its collapse. When your money doesn't work, your economy doesn't work. When your economy doesn't work, your empire doesn't work. Chapter 5. The invention of paper money, or China's genius mistake. China invented paper money during the Tang Dynasty, 7th to 9th centuries, though it became widespread during the Song Dynasty, 10th to 13th centuries. Here's how it started. Merchants deposited metal coins with the government and received paper certificates. These certificates could be exchanged for the coins later. It was basically a receipt, but merchants started trading the receipts instead of redeeming them. Why carry heavy coins when you can carry light paper that represents the coins? The government noticed and thought, what if we just issue the paper directly? We can print as much as we need. Infinite money. This worked. For a while, the Mongol Yuan dynasty, 13th to 14th centuries, under Kublai Khan, took paper money to its logical extreme. They banned metal coins entirely. Only paper money was legal. Marco Polo visited China during this period and was absolutely amazed. In Europe, money was metal. The idea of paper money seemed insane. He wrote detailed descriptions of how the Khan could create money from nothing, print paper, stamp it, and decree it valuable. European readers thought Marco Polo was either exaggerating or lying. Paper money? Ridiculous. But the Mongols had a problem. They kept printing money. Wars, construction projects, government expenses. Just print more money. Inflation exploded. By the end of the Yuan dynasty, paper money was worthless. People refused to accept it. The economy reverted to metal coins and barter. The Ming dynasty, 14th to 17th centuries, initially tried paper money again but abandoned it after another inflationary disaster. The lesson: paper money only works if you don't print too much. Restraint is required. Governments are historically terrible at restraint. Chapter 6. Europe figures out banking, kind of. While China was experimenting with paper money, medieval Europe was figuring out banking. The Catholic Church banned usury, charging interest on loans, as sinful. This created a problem. How do you have a functioning credit system if you can't charge interest? Jewish merchants and Italian bankers found workarounds. Jews were allowed to charge interest to non-Jews, though not to other Jews. Italians used creative accounting, calling interest fees or gifts, or structuring loans as partnerships. The Medici family in Florence became one of the most powerful families in Europe through banking. They had branches across Europe, facilitating trade and credit. They invented double-entry bookkeeping. Every transaction recorded twice, once as credit and once as debit. This made fraud harder and accounting more accurate. Boring, but revolutionary. European banking also invented bills of exchange. If to pay someone in another city, you'd give money to a bank in your city. The bank would send a letter, the bill of exchange, to the recipient. The recipient would take this letter to a bank in their city and receive money. No physical money moved between cities, just letters. This was faster, safer, bandits couldn't steal letters they didn't know were valuable, and more efficient. This is the beginning of banking as we know it. Money becoming abstract. Transactions happening on paper. Value moving through agreements rather than physical objects. Part 2. The modern system emerges. Chapter 7. The gold standard, or when money had to mean something. By the 19th century, most developed countries adopted the gold standard. Here's how it worked. Every unit of currency was backed by a specific amount of gold. You could, in theory, take your paper money to the government and exchange it for gold at a fixed rate. For example, in the US, $1 equaled 1/20th of an ounce of gold. Always. Guaranteed by law. This created stability. Governments couldn't just print unlimited money because they needed gold reserves to back it. If you printed more money than you had gold, people would demand the gold you couldn't deliver, and the system would collapse. The gold standard made international trade easier. If one British pound equals X amount of gold and one US dollar equals Y amount of gold, you could calculate exact exchange rates. Everything was pegged to gold. But the gold standard had problems. Deflationary pressure. As economies grew, they needed more money. But gold supply didn't grow as fast as economies did. This created deflation. Money became more valuable over time. Sounds good, right? Your money is worth more tomorrow than today. Wrong. Deflation is terrible. If money becomes more valuable over time, people hoard it instead of spending or investing it. Why buy something today if you can buy it cheaper tomorrow? Economic activity slows. This causes recessions. No flexibility during crises. During economic downturns, governments couldn't increase the money supply to stimulate the economy. They were constrained by gold reserves. During wars, countries went off the gold standard temporarily, because wars are expensive and require printing money. Then they tried to return to it, which caused economic chaos. Gold distribution problems. Some countries had lots of gold, others had little. This created imbalances. Countries with more gold had more monetary flexibility. Countries with less were constrained. The Great Depression. The gold standard made the Great Depression worse. Countries couldn't stimulate their economies through monetary policy. They were stuck. Countries that abandoned the gold standard earlier recovered faster. The gold standard persisted internationally until 1971, when the U.S. finally ended it completely under President Nixon. More on that later. Chapter 8. How Banks Create Money from Nothing. This will make you angry. Let's talk about fractional reserve banking, which is legal, standard practice, and sounds completely insane when you first hear about it. You deposit $1,000 in your bank account. You think, my $1,000 is sitting in the bank's vault with my name on it. Wrong. The bank is legally required to keep only a fraction of deposits as reserves. In the US, currently about 10%, actually 0% as of 2020. But we'll use 10% for this example because it's simpler and was the rule for decades. So the bank keeps $100 of your deposit and loans out $900 to someone else. That someone else takes their $900 loan and deposits it in their bank account. Maybe at the same bank, maybe at a different bank. Now that $900 is in the banking system. The second bank keeps 10%, $90, and loans out $810. That $810 gets deposited somewhere. That bank keeps $81 and loans out $729. This continues. Your original $1,000 deposit has created $900 in loans, creating $900 in someone's account. $810 in more loans, creating $810 in someone's account. $729 in more loans, creating $729 in someone's account. And so on. Mathematically, your $1,000 deposit eventually creates about $10,000 in the banking system. This is called the money multiplier effect. The bank didn't have $10,000, you deposited $1,000, but through the magic of fractional reserve banking, $10,000 now exists in the economy. This is, and I cannot stress this enough, completely legal, and how the entire modern banking system works. Banks literally create money out of nothing through lending. But here's the catch. It only works if everyone doesn't want their money at the same time. If everyone tries to withdraw their deposit simultaneously, a bank run, the bank doesn't have the money. It's been loaned out. The bank fails. This happened regularly in the 19th and early 20th centuries. Bank panics would start, everyone would rush to withdraw their money, banks would fail, and the economy would collapse. The solution? Deposit insurance. The government guarantees your deposits up to a certain amount, $250,000 in the US. This stops bank runs because people know their money is safe even if the bank fails. But this creates a moral hazard. Banks can take excessive risks because they know the government will bail out depositors. The 2008 financial crisis was partly caused by this dynamic. Chapter 9. Central banks, or who actually controls the money. Central banks are one of the most important institutions in modern economies, and most people don't understand what they do. The Federal Reserve, the U.S. central bank, usually called the Fed, was created in 1913 after a series of banking panics convinced everyone that maybe having a central authority managing the money supply was a good idea. Here's what central banks actually do: control the money supply. They can increase or decrease the amount of money in the economy. How? Mainly through open market operations, buying and selling government bonds. When the Fed wants to increase the money supply, it buys government bonds from banks. The Fed pays for these bonds by literally creating money, adding numbers to the bank's accounts. This new money enters circulation. When the Fed wants to decrease the money supply, it sells bonds to banks. Banks pay for these bonds, and that money is removed from circulation. Set interest rates. The Fed sets the federal funds rate, the interest rate banks charge each other for overnight loans. This rate influences all other interest rates in the economy. When the Fed raises rates, borrowing becomes more expensive everywhere. When it lowers rates, borrowing becomes cheaper. Why does this matter? Higher interest rates slow down the economy because borrowing is expensive, so people borrow and spend less. Lower interest rates stimulate the economy because borrowing is cheap, so people borrow and spend more. Act as lender of last as lender. Resort, During financial crises, the Fed can loan money to banks that are struggling. This prevents bank runs and financial panics. Regulate banks. The Fed oversees banks to ensure they're not taking excessive risks. Now here's where it gets political. Central banks are supposed to be independent from government. Why? Because if politicians controlled the money supply, they'd be tempted to print money before elections to stimulate the economy and make people happy, regardless of long-term consequences. Independent central banks can make unpopular decisions like raising interest rates to fight inflation without worrying about being voted out of office. But this creates a democratic problem. Unelected officials have enormous power over the economy. Different countries balance this differently. Some central banks are very independent, others are more subject to government influence. The Fed tries to balance two mandates: maximum employment and price stability, low inflation. These goals sometimes conflict. Stimulating employment can create inflation. Fighting inflation can increase unemployment. This balancing act defines modern monetary policy. Chapter 10. Inflation. Why your money loses value. Every year, inflation is when prices go up over time. Or, to put it another way, when your money buys less than it used to. In 1950, the average car cost about $1,500. Today, it's more like $35,000. That's inflation. Here's the weird thing. Moderate inflation is considered good. Wait, what? How is my money losing value good? Economists argue that 2 to 3% annual inflation is healthy for several reasons. It encourages spending. If money loses value over time, you're incentivized to spend or invest it rather than hoard it. This keeps the economy moving. It reduces real debt burden. If you borrow $100,000 at a fixed rate and inflation is 3% per year, the real value of your debt decreases over time. In 20 years, that $100,000 will be worth much less in real terms. This helps borrowers, like young people with mortgages, and hurts savers, like retirees with fixed income. It prevents deflation. Deflation, prices going down over time, sounds great but is actually terrible. If prices are falling, people delay purchases, economic activity slows, businesses cut jobs, which reduces spending further. It's a death spiral. Japan experienced deflation in the 1990s to 2000s, and it was economically devastating. But high inflation is also terrible. Uncertainty. When prices are changing rapidly, planning for the future becomes impossible. Businesses don't know what to charge. Consumers don't know what things will cost. Wealth destruction. Savings and cash become worthless. People on fixed incomes suffer. Social instability. High inflation creates anger and political instability. People feel like the system is broken. The extreme version is hyperinflation, when prices double every few days or hours. This has happened in Germany, 1920s, Zimbabwe, 2000s, Venezuela, 2010s, and other countries. In Zimbabwe's hyperinflation peak, prices doubled every 24 hours. A loaf of bread that cost $1 today would cost $2 tomorrow and $4 the day after. Money became worthless faster than you could spend it. The government printed a $100 trillion bill. It wasn't enough to buy a bus ticket. Hyperinflation destroys economies and societies. It's one of the worst economic disasters possible. So inflation is a balancing act. Too little is bad, too much is catastrophic, and 2 to 3% seems to be the sweet spot. Chapter 11. Why governments can't just print unlimited money. If governments can create money, why don't they just print unlimited amounts and make everyone rich? This is the most common question about money, and the answer reveals why money is so weird. The problem is that money itself isn't wealth. Money represents wealth, but it doesn't create it. Real wealth is goods and services. Food, houses, cars, healthcare, entertainment. These are created by workers, factories, farmers, and businesses. If you print more money but don't create more goods and services, you just have more money chasing the same amount of stuff. Prices go up. That's inflation. Here's an analogy. Imagine an auction with 100 people bidding on 10 cars. Now give everyone twice as much money. Are there suddenly 20 cars? No. There are still 10 cars. But now everyone has more money to bid with, so prices for the cars double. The economy works the same way. More money doesn't create more products. It just changes the price of existing products. Venezuela tried this. They had economic problems, so they printed massive amounts of money to pay for things, but they didn't increase production of goods and services. Result? Hyperinflation. A cup of coffee went from 450 bolivars to 1 million bolivars. Zimbabwe did the same. Printed money to pay for government expenses without increasing productivity. Hyperinflation destroyed the economy. The constraint on money printing is real resources. You can print as much money as your economy can produce goods and services to back it up. Print beyond that, and you get inflation. This is why developed countries can print more money than developing countries without immediate inflation. They have more productive capacity to absorb the new money, but even developed countries can't print infinitely. There's always a limit. Modern monetary theory, MMT, argues that governments that control their own currency can print more money than we currently think, as long as they watch inflation. If inflation stays low, they can keep printing. This is controversial. Critics say it's dangerous and will lead to inflation. Supporters say we're being too cautious and could fund more programs without triggering inflation. The COVID-19 pandemic tested this. Governments printed unprecedented amounts of money. Inflation remained low at first, then spiked in 2021 to 2022. Whether this was because of money printing, supply chain issues, or other factors is still debated. Chapter 12. The 2008 Financial Crisis, when money stopped working. Let's talk about 2008, when the global financial system nearly collapsed, and we all learned that too big to fail is a real thing. The setup. In the early 2000s, housing prices in the US were rising. Banks were giving mortgages to almost anyone, including people who couldn't afford them, subprime mortgages. Why? Because banks weren't keeping these mortgages. They were bundling them together and selling them to investors as mortgage-backed securities. It worked like this. 1. Bank gives mortgages to 1,000 people. 2. Bank bundles these mortgages together. 3. Bank sells this bundle to investors. 4. Investors receive payments as people pay their mortgages. 5. Bank uses money from sale to give more mortgages. 6. Repeat. This seemed great. Banks could give unlimited mortgages because they weren't taking the risk investors were. And as long as housing prices kept rising, everyone made money. But there was a problem. These bundles included good mortgages, people who could pay, and bad mortgages, people who probably couldn't pay. The bundles were sliced and diced and repackaged so many times that nobody really knew what they contained. Rating agencies, the companies that evaluate how risky investments are, gave these bundles high ratings, saying they were safe. They were being paid by the banks creating the bundles, which created a conflict of interest. Then housing prices stopped rising. People with subprime mortgages couldn't afford payments. They defaulted. The mortgage-backed securities started failing. Investors panicked. Banks panicked. Nobody knew which banks were holding toxic assets, worthless mortgage bundles, and which were safe. Credit froze. Banks stopped lending to each other because they didn't trust each other. If banks can't lend to each other, the economy stops. Major investment banks failed. Lehman Brothers, one of the largest, went bankrupt. The government let it fail, thinking it would teach the market a lesson. Bad idea. Lehman's failure triggered a global panic. The entire financial system was on the verge of collapse. The government stepped in with massive bailouts. Banks got hundreds of billions of dollars. The Fed created trillions of dollars to support the financial system. This was controversial. People were angry that banks got bailed out while homeowners lost their homes. Privatized profits, socialized losses, became a rallying cry. But the alternative, letting the entire financial system collapse, would have been worse. The Great Depression 2.0, the crisis revealed how interconnected and fragile the modern financial system is. It also showed that when push comes to shove, governments will print whatever money is necessary to prevent total collapse. Inflation didn't happen immediately, though it came later. The crisis actually created deflation risks because the economy contracted so much. The lesson: modern money is complex, interconnected, and vulnerable to crashes that nobody fully understands until they happen. Part 3. Money in your life. Chapter 13. Why your bank account is a lie. Let's get personal. You check your bank account. It says you have $5,000. What does that actually mean? You think it means there's $5,000 with my name on it in a vault somewhere. Reality: the bank has loaned out most of your deposit. Your $5,000 is partly a promise that if you ask for it, they'll give it to you, but they're counting on you not asking for all of it at once. Your checking account is actually a liability for the bank. They owe you money, but they're using that money to create assets, loans, that make them profit. The interest you earn on savings, if any, most checking accounts pay basically nothing, is much lower than the interest the bank charges on loans. The difference is profit. Your bank is essentially borrowing money from you at 0.01% interest and lending it to others at 5 to 20% interest. Nice work if you can get it. But here's the thing. This system only works because of trust. You trust that when you want your money, it'll be there. The bank trusts that not everyone will want their money at the same time. This trust is backed by FDIC insurance. The government guarantees deposits up to $250,000. If your bank fails, you get your money back. Central bank support. The Fed can loan money to banks in trouble. Regulations. Banks are required to keep certain reserves and maintain certain ratios of assets to liabilities. But these protections are relatively recent. Before the 1930s, bank runs were common and devastating. You'd hear your bank was in trouble, rush to withdraw your money, only to find it wasn't there because everyone else had the same idea. Modern banking is more stable but still fundamentally based on trust and collective belief. Chapter 14. Credit cards, the most profitable scam. That's totally legal. Credit cards are genius from the card company's perspective and often terrible for users. Let's break down why. When you use a credit card, you're borrowing money. If you pay it back within the grace period, usually about 25 days, you pay no interest. If you don't pay it back fully, you pay interest, typically 15 to 25% APR. 25% annual interest is loan shark territory, except it's completely legal. Here's how credit card companies make money. Interest from cardholders. This is the big one. Americans carry about $1 trillion in credit card debt, paying billions in interest annually. Transaction fees for merchants. Every time you use a card, the merchant pays a fee, usually 2 to 3% of the purchase. This is why some small businesses have credit card minimums or prefer cash. Annual fees. Some cards charge yearly fees for the privilege of using them. Late fees and penalty fees. Miss AI. Payment? That'll be $25 to $35. Go over your limit? Another fee. Foreign transaction fees? Use your card abroad? Extra fees. From the card company's perspective, this is beautiful. They make money whether you pay off your balance, transaction fees from merchants, or don't, interest from you. From your perspective, credit cards can be a tool or a trap. The trap. You spend money you don't have. The bill comes. You can't pay it all. You pay minimum payment. Interest accumulates. You keep spending. Debt grows. You're stuck. This is by design. Credit card companies market to people who will carry balances. They make much more money from people who pay interest than from people who pay in full. The tool, if you pay off your balance every month, credit cards are essentially free money. You get rewards, cash back, points, miles, fraud protection, and a grace period on purchases, and you pay no interest. The credit card companies count on most people not having this discipline. Chapter 15. Why rich people use debt and poor people should avoid it. Here's a paradox. Wealthy people use debt all the time. Poor people are often told to avoid debt. What gives? The key is understanding good debt versus bad debt. Bad debt. Borrowing money to buy things that lose value. Credit card debt for consumer purchases. Car loans for depreciating vehicles. Payday loans at 400% interest. This debt makes you poorer. You're paying interest on things that don't generate returns. Good debt. Borrowing money to buy things that increase in value or generate income, mortgages on appreciating real estate, business loans that fund profitable ventures, student loans for education that increases earning potential. Maybe. This one's complicated. This debt can make you wealthier if used correctly. Wealthy people use debt strategically. They borrow against assets at low interest rates. They use debt to invest in things that return more than the interest rate. They use debt for tax advantages. Mortgage interest is tax deductible. They use leverage to amplify returns. Poor people often have access only to bad debt. High interest credit cards, payday loans with predatory rates, rent-to-own schemes that cost multiples of retail price, car title loans that can cost over 300% APR. The system is designed to make rich people richer through debt and poor people poorer through debt. This is why financial literacy matters. Understanding how debt works is the difference between using it as a tool and being crushed by it. Chapter 16: The Retirement Crisis. Nobody wants to talk about. Most people won't have enough money to retire. Let's discuss why. Previous generations had pensions. Your employer would pay you a fixed amount every month after retirement until you died. The employer took all the risk of making sure there was enough money. That system is mostly dead. It's been replaced by 401s, Ks, and IRAs, retirement accounts where you contribute money, maybe your employer matches some of it, and you invest it yourself. This shifts all the risk to you. You have to save enough, most people don't. Invest correctly, most people don't. Not panic and sell during market crashes, most people do. Make your money last for an unknown number of years. The average American near retirement has about $144,000 saved. Sounds decent until you realize the average retirement lasts 20 to 30 years. Healthcare costs are expensive and rising. You can't rely on Social Security alone. The average SS payment is about $1,500 per month. Do the math. $144,000 spread over 25 years is $5,760 per year, or $480 per month. Add Social Security, and you're at about $2,000 per month. Can you retire on $2,000 per month? Maybe, if you own your home outright and stay healthy, but probably not comfortably. The recommended amount to retire is about 25 times your annual expenses. If you spend $40,000 per year, you need $1 million saved. Most people won't. Get close. This creates a retirement crisis that's building slowly. In 20 to 30 years, we'll have millions of elderly people who can't afford to stop working and can't afford retirement. Solutions proposed include raise Social Security benefits, expensive for government, require higher savings rates, hard for people already struggling, raise retirement age, unpopular and unfair to people with physical jobs, universal basic income for elderly, controversial and expensive. None of these solutions are easy or likely to happen soon. The individual solution: start saving early, max out tax-advantaged accounts, invest in low-cost index funds, and hope markets perform well. But not everyone can do this, especially when wages are stagnant and costs are rising. Chapter 17: Why Inflation Helps Debtors and Hurts Savers. Let's talk about a dynamic that fundamentally shapes who wins and loses in the economy. Imagine you borrow $100,000 at a 5% fixed interest rate. Your payments are fixed. Now imagine 3% annual inflation. Year 1, you pay $5,000 in interest. That's 5% of $100,000. Year 10, you pay $5,000 in interest, but due to inflation, that $5,000 is worth less in real terms, about $3,860 in year $1. Your debt burden effectively decreases over time, even though you're paying the same amount. If your income rises with inflation, big if, your payments become easier over time. This is why inflation helps debtors. Now imagine you have $100,000 in savings, earning 1% interest in a savings account. With 3% inflation, your money loses 2% of purchasing power each year. Year 1, your $100,000 buys $100,000 worth of stuff. Year 10, your money has grown to $110,462, but accounting for inflation, that's worth only about $84,730 in year 1 purchasing power. You've lost money by saving it. This is why inflation hurts savers. Here's who wins with inflation: borrowers with fixed rate debt, younger people with mortgages, governments with large debts. They pay back debt with devalued currency. People who own assets that appreciate with inflation, real estate, stocks. Here's who loses: savers with cash, retirees on fixed incomes, people in developing countries where wages don't keep pace with inflation, anyone whose income doesn't rise with inflation. Central banks target moderate inflation partly because it benefits debtors and encourages spending over saving. But this creates winners and losers. The system is designed to advantage borrowers and asset owners. If you understand this, you can position yourself to benefit. If you don't, you might be on the losing side without realizing it. Chapter 18: The Stock Market: Legalized Gambling or Wealth Creation. The stock market is sold as a way for ordinary people to build wealth. Is it? When you buy a stock, you're buying a small piece of a company. If the company does well, the stock price goes up. If it does poorly, the price goes down. In theory, the stock market should reflect the real economy. Companies that create value should have rising stock prices. Companies that don't should have falling stock prices. In practice, the stock market is influenced by company performance, rational, economic conditions, rational, interest rates, rational, investor psychology, irrational, market momentum, irrational, rumors and speculation, irrational, algorithmic trading, complicated, short-term thinking, problematic. The result is that stock prices often don't reflect real value. They reflect what investors think other investors will pay. This creates bubbles. Dot-com bubble in 2000, housing bubble in 2008, crypto bubble in 2021. Investors pile into assets not because they're worth the price, but because prices are rising and they want in. Then the bubble pops. Prices crash. People lose fortunes. But here's the thing. Over the long term, the stock market has historically gone up. Since 1926, the S&P 500 has averaged about 10% annual returns. This means if you invest for decades and don't panic sell during crashes, you'll probably do well. Most people can't do this. They buy high when everyone's excited and sell low when they panic. They try to time the market. They chase hot stocks. They listen to financial media predicting the next crash or rally. Professional investors with algorithms and inside information barely beat the market. Regular people definitely can't. The best strategy for most people: buy low-cost index funds, invest regularly regardless of market conditions, and ignore short-term fluctuations. This is boring. It doesn't feel like you're beating the system, but it works. The stock market is wealth creation for people who treat it as long-term investment. It's gambling for people who try to outsmart it. Chapter 19, Cryptocurrency, the Future of Money or Elaborate Scam. Let's talk about cryptocurrency, which is either revolutionary or a massive scam depending on who you ask. The core idea behind Bitcoin, the first cryptocurrency, is simple: create digital money that doesn't require banks or governments. How? Through blockchain technology, a distributed ledger where every transaction is recorded across thousands of computers. No single entity controls it. No government can shut it down. No bank can freeze your account. This appeals to people who distrust governments and central banks, want financial privacy, live in countries with unstable currencies, are libertarian/anarchist leaning, want to get rich quick. We'll get to this. Bitcoin has real advantages. Decentralized, no single point of failure, limited supply, only 21 million will ever exist. Borderless, send it anywhere instantly. No intermediaries, no bank fees. But Bitcoin also has serious problems. Volatility, prices swing wildly, down 50% one month, up 100% the next. Terrible for actually using as currency. Energy consumption. Bitcoin mining uses as much energy as entire countries. Environmental disaster. Transaction speed. Bitcoin processes about 7 transactions per second. Visa processes thousands. Bitcoin is slow and expensive per transaction. Irreversibility. Send Bitcoin to wrong address. It's gone forever. No customer service to call. Criminality. Used for money laundering, ransomware, dark web markets, though cash is also used for crime. Speculation. Most people buy crypto not to use it, but hoping price goes up. The bigger question, is cryptocurrency actually solving a problem? In developed countries with stable currencies and functioning banks, cryptocurrency doesn't offer much advantage. Yes, banks have fees and sometimes freeze accounts, but they also provide customer service, fraud protection, and stability. In developing countries with hyperinflation or authoritarian governments, cryptocurrency offers real benefits. If your country's currency is collapsing or your government might seize your assets, Bitcoin is attractive. But the vast majority of crypto investment is speculation, people buying hoping to sell higher. This creates bubbles. Bitcoin hit $64,000 in 2021, then crashed to $16,000 in 2022, then rose again. Thousands of other cryptocurrencies have appeared. Most will become worthless. Is cryptocurrency the future of money? Probably not in its current form. The technology has potential. Blockchain could revolutionize finance, but current cryptocurrencies have too many problems to replace traditional money. More likely, central banks will create digital currencies using blockchain technology, giving us crypto benefits without the volatility and energy waste. Or crypto could prove me wrong and take over. Nobody knows. That's what makes it interesting and terrifying. Chapter 20. Why some countries are rich and others are poor. Here's an uncomfortable question. Why are some countries rich and others desperately poor? The answer is complicated and involves history, geography, institutions, culture, colonialism, and yes, money. Institutions matter. Countries with stable governments, property rights, rule of law, and low corruption tend to be richer. If you can't trust that contracts will be enforced or that the government won't seize your property, you won't invest or build businesses. Compare North and South Korea. Same people, same history until 1945. One has functioning institutions and is wealthy. One has dysfunctional institutions and is impoverished. The difference is governance. Colonial history matters. Countries that were colonized often had extractive institutions imposed, systems designed to extract resources for colonizers, not develop local economies. These institutions persisted after independence, creating poverty traps. Geography matters. Landlocked countries have trouble trading. Countries in hot climates face health challenges, malaria, parasites. Countries with navigable rivers and natural ports have trade advantages. But none of this is destiny. Singapore is tiny with no natural resources and was poor in the 1960s. Now it's one of the world's richest countries. Strong institutions and strategic decisions made the difference. The poverty trap. Poor countries often can't escape poverty because they can't afford infrastructure. Roads, power, water. They can't afford education, creating skilled workforce. They can't attract investment, too risky, unstable. They rely on agriculture or resource extraction, low value add. They have high debt, paying interest instead of building. Breaking this cycle requires massive capital investment, which poor countries don't have. Foreign aid and loans help but create dependency and debt. Currency matters. Rich countries control stable currencies. Poor countries often have weak currencies that lose value, making imports expensive and savings worthless. Zimbabwe's hyperinflation destroyed the economy. Eventually, they abandoned their currency entirely and use US dollars now. A country's monetary system reflects and reinforces its wealth or poverty. Stable currency enables economic growth. Unstable currency causes economic chaos. The global financial system favors rich countries. They can borrow cheaply. Their currencies are trusted. They can print money without immediate inflation. Poor countries borrow expensively. Their currencies aren't trusted, and printing money causes instant inflation because their economies lack productive capacity. This creates a two-tier global system, where rich get richer and poor struggle to catch up. Part 4. The Global Money Game. Chapter 21. Exchange Rates. Why your dollar buys different amounts. Everywhere you take a vacation to Europe, you trade your dollars for euros at an exchange rate of $1 equals 0.92 euros. 6 months later, you go back. Now $1 equals 0.85 euros. Your dollar buys less. What happened? Exchange rates. How much one currency is worth in another. Currency are determined by supply and demand in currency markets. Factors that affect exchange rates, interest rates. If U.S. interest rates rise, foreign investors want U.S. bonds, so they need dollars. Demand for dollars increases, dollar strengthens. Economic performance, strong economy equals strong currency. Investors want to invest where growth is happening. Inflation, higher inflation weakens currency. If inflation is 5% in the US and 2% in Europe, the dollar should weaken against the euro. Political stability, unstable countries have weak currencies. Investors flee to stable currencies. Dollar, euro, Swiss franc, yen. Trade balance, countries that export more than import have stronger currencies. High demand for their currency to buy their exports. Countries that import more than export have weaker currencies. Central bank actions. When central banks change interest rates or print money, exchange rates shift. Speculation. Currency traders betting on future movements can create self-fulfilling prophecies. This creates weird dynamics. A strong currency sounds good but hurts exports. Your goods are more expensive for foreigners. A weak currency sounds bad but helps exports. Your goods are cheaper for foreigners. Governments sometimes deliberately weaken their currencies to boost exports. This is called currency manipulation, and other countries hate it. China was accused of this for years, keeping the yuan artificially cheap to make Chinese exports competitive. The alternative is a fixed exchange rate. Government commits to keeping the currency at a specific value against another currency, usually the dollar. This provides stability but removes flexibility. If your economy needs different monetary policy than the currency you're pegged to, you're stuck. Argentina has repeatedly tried and failed to maintain fixed exchange rates. Each time, economic crisis forced them to abandon the peg, causing massive currency. Devaluation and economic pain. Exchange rates are one of those things that seem simple but are actually hideously complex, with governments, central banks, and trillion-dollar markets all trying to game the system. Chapter 22. The dollar's special status and why it won't last forever. The US dollar is the world's reserve currency. This gives the US enormous advantages. Here's what reserve currency means. International trade is priced in dollars. Oil is sold in dollars. International contracts are often denominated in dollars. Even if Russia sells oil to China, they often use dollars. Central banks hold dollars as reserves. Countries keep dollars, usually as US Treasury bonds, as savings. About 60% of global foreign exchange reserves are dollars. Dollar is the safe haven. During global crises, everyone buys dollars, even if the US caused the crisis. This special status gives the US cheap borrowing. Everyone wants US bonds, so the US can borrow at lower interest rates than other countries. Ability to print money. The US can print dollars without immediate inflation because global demand absorbs the new money. Other countries can't do this. Economic leverage. The US can impose financial sanctions that cut countries off from the dollar system. This is devastating because so much global trade requires dollars. Privilege of paying debts in own currency, most countries must borrow in dollars or euros. When their currency weakens, their debt becomes more expensive. The US borrows in dollars so it can always pay debts by printing more dollars. This is called exorbitant privilege, and other countries resent it. But the dollar's dominance isn't guaranteed forever. Several factors threaten it. Rising US debt. If the US keeps borrowing unsustainably, confidence in the dollar could collapse. Challengers emerging. The euro was supposed to compete with the dollar, but hasn't succeeded. The Chinese yuan is being slowly internationalized. Digital currencies might create alternatives. Weaponization of the dollar. The US uses dollar-based sanctions as foreign policy. Countries sanctioned, Russia, Iran, Venezuela, have incentive to create dollar alternatives. Even US allies worry about dollar dependency. De-dollarization efforts. Russia, China, and others are conducting trade in their own currencies, bypassing the dollar. If the dollar lost reserve status, the US would face higher interest rates on debt, inability to print money without inflation, loss of economic leverage, reduced standard of living as imports become expensive. This would be a fundamental shift in global power. The US has maintained dollar dominance through economic strength, military power, network effects. Everyone uses dollars because everyone uses dollars. Lack of viable alternatives, but empires fall, currencies lose status, and nothing lasts forever. The British pound was the reserve currency until the mid-20th century. Now it's the dollar. Eventually, it'll be something else. Chapter 23. How sanctions work, or don't work. Financial sanctions are supposed to force countries to change behavior by cutting them off from the global financial system. Here's how they work. The US or EU or UN declares that no one can do financial transactions with a target country. Banks that violate sanctions face huge fines and loss of access to dollar/euro systems. Since most global trade flows through dollars, this effectively cuts the target off from global commerce. Recent examples: Russia, 2014 and 2022. Sanctions after Crimea annexation and Ukraine invasion. Cut off from SWIFT, international payment system, assets frozen, trade restricted. Iran, decades of sanctions over nuclear program. Devastated economy, but didn't change government behavior. North Korea, extreme isolation. Haven't changed behavior, but population suffers. Venezuela, sanctions over authoritarianism, economic collapse, but Maduro still in power. Do sanctions work? Sometimes, South Africa's apartheid regime eventually fell partly due to sanctions. Serbia ended actions in Kosovo after sanctions. Often not. Authoritarian governments don't care if their population suffers. Sanctions can even strengthen regimes by creating rally around the flag effects and blaming foreigners for problems. Sanctions also create unintended consequences. Humanitarian damage. Ordinary people suffer more than elites. Medicine, food, and basic goods become scarce. Black markets. Sanctioned countries find workarounds, using other currencies, creating smuggling networks, using cryptocurrency. Pushback against dollar system. Countries worry they could be next, so they develop dollar alternatives. Collateral damage. Companies that accidentally violate sanctions face huge fines. This makes everyone overly cautious, hurting legitimate trade. Ineffectiveness. Creep. The more sanctions are used, the more countries develop immunity to them. The fundamental problem, sanctions are less severe than war, but more severe than diplomacy. They're a middle option that doesn't fully solve problems, but makes everyone feel like they're doing something. They work best when multilateral, everyone cooperates, targeted at elites rather than population, combined with diplomatic solutions, applied to countries dependent on international trade. They work worst when unilateral, one country alone, blanket sanctions on everything, no endgame or path to lifting them, applied to countries that can survive in isolation. Modern financial sanctions show both the power of controlling the global financial system and the limits of that power. Chapter 24, Tax Havens, Where Money Goes to Hide. Let's talk about tax havens, places where money goes to avoid taxes and scrutiny. Famous tax havens, Cayman Islands, more registered companies than people. Banks hold trillions. Switzerland, famous for banking secrecy, though this has weakened recently. Luxembourg, tiny country, huge financial sector. Panama, the Panama Papers revealed how much money hides here. Delaware, U.S. Yes, a U.S. state is a tax haven. More corporations registered than people. How tax havens work. Low or no taxes. These places charge minimal taxes to attract foreign money. Banking secrecy. Don't ask questions about where money comes from or who owns it. Shell companies. Create companies that exist only on paper, obscuring real ownership. No substance requirements. You can register a company without having any actual presence there. Why do they exist? Competition for capital. Small countries can't compete in manufacturing or services, so they compete to attract financial capital. Sovereignty. Every country can set its own tax laws. Others can't force them to change. Demand. Rich people and corporations want to avoid taxes. Tax havens supply that service. Who uses tax havens? Legitimate users, companies structuring international operations, wealthy individuals legally minimizing taxes, investment funds pooling international capital, illegitimate users, tax evaders hiding income, money launderers cleaning criminal proceeds, corrupt officials hiding stolen wealth, sanctions evaders hiding transactions. The line between tax avoidance, legal, and tax evasion, illegal, is technically clear but practically murky. If you use legal loopholes to pay less tax, that's avoidance. If you hide income or lie about assets, that's evasion. But the loopholes are often designed by people who benefit from them, making the whole system ethically questionable even when technically legal. The scale is staggering. Estimates suggest $7 to $10 trillion is held in tax havens globally. Governments lose hundreds of billions in tax revenue annually. This money is hidden through complex structures, companies owning companies across multiple jurisdictions, making it nearly impossible to trace real ownership. Efforts to combat this include FATCA, U.S., requires foreign banks to report U.S. citizens' accounts or face penalties, controversial but effective. Common reporting standard, international agreement for automatic exchange of tax information, reduces banking secrecy. Public beneficial ownership registries, requiring disclosure of who really owns companies. Implemented in some countries, resisted in others. Minimum corporate tax. G20 agreed to 15% minimum corporate tax to reduce race to the bottom. Implementation ongoing, but tax havens adapt. When one loophole closes, another opens. It's a cat and mouse game between regulators and the financial industry. The fundamental issue, as long as some jurisdictions offer secrecy and low taxes, money will flow there. Solving this requires global cooperation, which is hard when some countries benefit from being tax havens. Chapter 25: How the Super Rich Use Money. Differently. The ultra-wealthy, billionaires and near-billionaires, use money in ways fundamentally different from everyone else. They don't keep money in cash. Jeff Bezos doesn't have $100 billion in a checking account. His wealth is in Amazon stock, real estate, companies, and investments. They borrow against assets. Instead of selling stock and paying capital gains tax, they borrow money using stock as collateral. Interest rates are low, loans aren't taxed, and they can deduct the interest. This creates a weird loop: borrow to live, use investment returns to pay interest, never sell assets, never pay taxes. When they die, assets pass to heirs with stepped-up basis, meaning the heir's tax basis is the value at death, not the original value. They can sell immediately without capital gains tax. This is called buy, borrow, die, and it's how billionaires pay lower effective tax rates than middle-class workers. They use foundations and trusts, create charitable foundations to control assets, get tax deductions, influence society, and create family employment. The foundation is tax-exempt. The family controls it. They can't use foundation money personally, but they can fund causes they care about, employ family members, and maintain influence. Trusts separate legal ownership from beneficial use. Assets in a trust might not technically be yours, but you can benefit from them. They invest in assets unavailable to regular people. Private equity, hedge funds, venture capital, private real estate deals, exclusive investment partnerships. Many of these require minimum investments of millions of dollars. The best investment opportunities are reserved for people who already have money. They don't pay retail prices. Everything is negotiable when you have enough money. Real estate, services, even taxes, through legal structuring. They use different tax strategies: carried interest for fund managers, taxed at lower capital gains rate instead of income rate, opportunity zones, tax breaks for investing in designated areas, 1031 exchanges, defer real estate taxes indefinitely, and countless other legal strategies unavailable or impractical for regular people. They can lose money without consequences. If you lose your job, you might lose your house. If a billionaire loses $1 billion, they're still a billionaire. This creates asymmetric risk-taking. They can make big bets because even total loss doesn't meaningfully impact their life. They influence the rules. Through lobbying, campaign donations, and economic influence, the ultra-rich shape laws governing money and taxes. This isn't conspiracy. It's openly how the system works. Wealthy people fund politicians. Those politicians write favorable laws. Wealthy people benefit, rinse, and repeat. The result: the financial system has different rules. For different people, not officially. The law applies equally on paper. But in practice, if you can afford sophisticated tax planning, you pay less as a percentage of wealth than people who can't. This contributes to wealth concentration. The rich get richer not just because they have more to invest, but because the system is structured to preserve and grow wealth once you have it. Chapter 26: Modern Monetary Theory. The Controversial New Economics. Modern monetary theory, MMT, is an economic framework that's either revolutionary or dangerously wrong, depending on who you ask. Here's the core claim. Countries that issue their own currency, like the US, Japan, UK, can never run out of money. They can always create more. This sounds like the thing we said governments can't do, print unlimited money. But MMT proponents say we've been thinking about it wrong. Traditional view: 1. Government needs to spend money. 2. Government must either tax or borrow. 3. Too much borrowing creates unsustainable debt. 4. Therefore, spending is constrained by revenue. MMT view: 1. Government creates money when it spends. 2. Taxes delete money, remove it from circulation. 3. Government bonds are savings accounts for the wealthy, not funding mechanism. 4. Real constraint is inflation, not debt. The implications are radical. Deficits don't matter as long as inflation is controlled. The government can spend as much as needed without worrying about debt levels. Unemployment is a choice. Government could guarantee jobs to anyone who wants one by funding job programs. We can afford social programs, universal health care, free college, green energy transition, all affordable. because government can create money to fund them. The constraint is real resources and inflation. If government spending drives demand beyond what the economy can produce, inflation happens. That's the limit. MMT critics say this causes hyperinflation. Unlimited spending will definitely cause runaway inflation. Look at Venezuela, Zimbabwe, Weimar Germany, MMT responses. Those countries had real economic problems: loss of production, war, corruption. The US has massive productive capacity that can absorb spending. Bond markets will revolt. If the US racks up massive debt, bond buyers will demand higher interest rates or refuse to buy. MMT response. Countries with their own currency can't be forced into default. Japan has debt over 200% of GDP and interest rates near zero. Political danger. Even if theoretically possible, giving politicians permission to spend unlimited money is asking for disaster. MMT response. Politicians already spend irresponsibly. At least this framework is honest about how money works. It's not really new. MMT describes how the system already works but claims it's novel. MMT response. We're making explicit what was implicit and showing the possibilities. The COVID-19 pandemic was an MMT test. Governments printed trillions. Inflation stayed low at first, supporting MMT. Then inflation spiked in 2021 to 2022, supporting critics. Was the inflation from money printing, supply chains, energy prices, or corporate greed? Economists disagree. MMT is controversial because it challenges fundamental assumptions about government budgets, debt, and spending constraints. It tells politicians they can do more than they think. Whether MMT is right depends on whether inflation really is the only constraint, or whether there are other limits, political, practical, international, that make unlimited spending impossible even with monetary sovereignty. Time will tell. Either MMT will be recognized as breakthrough understanding of modern money, or it'll be remembered as the theory that led to economic disaster. Part 5. The Future of Money. Chapter 27. Central bank digital currencies. Governments strike back Bitcoin and cryptocurrencies spooked central banks. Their response: create their own digital currencies. Central bank digital currencies, CBDCs, are government-issued digital money, like cryptocurrency, but controlled by central banks. How would it work? Instead of money in a bank account, which is a bank's promise to pay you, CBDCs would be direct claims on the central bank. You'd have a digital wallet. Your money would be stored directly with the central bank or a central bank-backed system. Advantages claimed: financial inclusion. People without bank accounts could have digital wallets. No more check cashing fees or payday loans. Faster payments. Instant settlement between parties. No waiting days for checks to clear. Reduced costs. No physical cash to print, transport, or secure. Better monetary policy. Central banks could implement negative interest rates, charge people for holding money, to encourage spending during recessions. Reduced crime. Harder to use for money laundering, tax evasion, and illegal transactions. All transactions tracked. Financial stability. No more bank runs. Your money is with central bank, not commercial bank. Disadvantages and concerns. Privacy destruction. Every transaction tracked by government. They'd know everything you buy. Government control. Your money could be turned off. Dissidents, protesters, or anyone the government doesn't like could be financially frozen. Programmable money. Government could set expiration dates on money, spend it or lose it, restrict what you can buy, or implement social credit systems. Cybersecurity risks. One hack could compromise the entire monetary system. Bank disintermediation. Commercial banks might become obsolete if everyone banks with the central bank. This could destabilize the financial system. China is furthest along with the digital yuan. They've run massive trials. Concerns about surveillance and control are highest there. The digital yuan could be integrated with China's social credit system. Other countries are researching or piloting CBDCs: Sweden, e-krona, Bahamas, Sand Dollar, and many others. The US is cautious. The Fed is researching CBDCs but hasn't committed. Concerns about privacy and commercial bank disruption slow progress. CBDCs are probably inevitable in some form. The The question is how they're designed to empower citizens or control them. The same technology that could eliminate poverty and financial exclusion could also create unprecedented surveillance and control. The future of money might be digital, instant, and convenient. It might also be monitored, controlled, and restricted. Chapter 28: The Cashless Society. What we lose when we go. Digital cash is dying. In some countries, Sweden, Netherlands, it's nearly gone. Most transactions are digital. Benefits of going cashless: convenience, no fumbling with change, tap your card or phone and go. Hygiene, cash carries germs. COVID accelerated cashless adoption. Reduced crime, can't rob a store that doesn't have cash. Harder to launder money. Tax collection, harder to hide income if everything is tracked. Efficiency, processing cash is expensive. Digital is cheaper, but we lose important things. Privacy, cash is anonymous. Digital isn't. Every purchase creates a data trail. Corporations track your spending, build profiles, target ads, and sell your data. Government can access records. Financial inclusion, millions lack bank accounts or credit cards. Going cashless excludes them. Homeless people can't accept digital payments. Many poor people rely on cash. Autonomy, cash works without internet, electricity, or functioning payment systems. During natural disasters or system failures, cash still works. Digital doesn't. Freedom from corporate control. Visa, MasterCard, and banks control digital payments. They can deny service or charge fees. De-banking, being cut off from financial services, can happen for legal but controversial activities. Resilience. Cash is decentralized. No single point of failure. Digital payment systems are centralized. Hack them or shut them down, and the economy stops. Teaching tool. Cash makes spending tangible. Studies show people spend more with cards than cash because it doesn't feel real. Kids learning about money benefit from physical cash's tangibility. Some countries are mandating cash acceptance to protect against full digital transition. Others are pushing toward entirely cashless systems. The trend is clearly toward less cash. Whether that's good or bad depends on whether you value privacy and autonomy more than convenience and efficiency. Chapter 29: The Inequality Crisis. When money concentrates at the top. Here's an uncomfortable fact. Wealth inequality is at levels not seen since the Gilded Age of the 1920s. In the US, the top 1% own about 32% of all wealth. The top 10% own about 70% of all wealth. The bottom 50% own about 2% of all wealth. This isn't just about fairness. Extreme inequality creates economic problems, reduced consumer spending. Rich people save more of their income. Poor people spend almost everything. When wealth concentrates at the top, overall spending decreases. Asset bubbles. Rich people invest their wealth. Massive amounts of money chasing limited investment opportunities inflates asset prices. Stocks, real estate, art. This makes assets unaffordable for regular people. Political capture. Wealthy people have outsized political influence through campaign donations and lobbying. They shape policies to benefit themselves, creating a feedback loop. Social instability. Extreme inequality creates resentment, populism, and political extremism. Historically, societies with high inequality are unstable. Reduced economic mobility. When wealth is concentrated, it's harder for people to move up economically. Starting a business, getting education, buying a home, all require capital that's increasingly concentrated at the top. How did we get here? Tax policy. Tax rates on top earners have dropped dramatically since the 1950s to 70s. Top marginal tax rate was 70 to 90% then. It's 37% now. Capital gains taxes, which primarily affect wealthy, are lower than income taxes. Financialization. Increasingly, money comes from financial activities, trading stocks, private equity, hedge funds, rather than productive activities. Making things, providing services. Financial returns disproportionately benefit the wealthy. Globalization. Companies can source labor globally, paying workers less. But capital ownership is concentrated in developed countries. Owners benefit, workers compete globally. Technology, winner takes all dynamics. One tech platform dominates, making founders billionaires while displacing workers. Decline of unions. Unions bargained for workers to share in productivity gains. Union membership has collapsed, and workers have less bargaining power. Housing. Real estate appreciation has made homeowners wealthier, but it's priced out younger generations from buying homes. Education costs. College is increasingly expensive. Wealthy families can afford it, others go into debt. This creates educational inequality that reinforces wealth inequality. Solutions proposed: progressive taxation, higher taxes on high earners and wealth. Wealth taxes, annual tax on net worth above certain threshold, controversial and difficult to implement. Universal basic income, everyone gets baseline income, reducing poverty and inequality. Stronger unions, collective bargaining to share productivity gains with workers. Campaign finance reform, reduce wealthy people's political influence. Free college/healthcare, reduce costs that burden poor and middle class. Housing policy, increase supply, reduce speculation, make housing affordable. None of these are politically easy. The wealthy have power to resist policies that would reduce their wealth. Politicians depend on wealthy donors. But historically, extreme inequality doesn't last forever. It ends either through policy reforms, New Deal in 1930s, or through social upheaval, revolutions. Where we're headed depends on whether policy can address inequality before social breaking point. Chapter 30. What happens when the money system breaks? We've discussed how money works. Let's discuss what happens when it doesn't. Hyperinflation. We've mentioned this before, but let's go deeper. In hyperinflation, money loses value so fast that prices change during the day. You buy bread in the morning for X, it costs 2X in the afternoon. People get paid, immediately spend everything, because tomorrow it'll be worth less. Savings are wiped out. Pensions become worthless. Everyone's wealth held in currency evaporates. This happened in Weimar Germany, 1923, printed money to pay war reparations. Inflation hit 29,500% per month. Hungary, 1946. Worst hyperinflation in history. Prices doubled every 15 hours. Zimbabwe, 2008. Inflation hit 79.6 billion%. Printed $100 trillion bills. Venezuela, 2016 to present. Ongoing hyperinflation. Economy collapsed. Causes are usually excessive money printing, loss of productive capacity, war, sanctions, mismanagement, loss of confidence in currency. Political instability. Recovery requires stop printing money, create new currency, restore productive capacity, rebuild trust. But the damage lasts generations. People who live through hyperinflation never trust currency again. Deflation, the opposite problem. Prices fall, money gains value. Sounds great until you realize people delay purchases. Why buy now if it's cheaper later? Businesses cut production and jobs. Unemployment rises. Debt becomes more burdensome in real terms. Economy spirals downward. Japan experienced this for decades. It's economically devastating. Currency crises. When a country's currency suddenly collapses in value, usually happens when country has large foreign debt. Foreign investors lose confidence. Everyone rushes to sell currency. Currency collapses. Debt becomes unpayable. Economic crisis. 1997. Asian financial crisis. 1998 Russian financial crisis. 2001 Argentine crisis. All followed this pattern. Bank runs. Everyone tries to withdraw money simultaneously. Bank doesn't have it. Fractional reserve. Bank fails. Panic spreads. Before deposit insurance, this happened regularly. Now it's rare but not impossible. Silicon Valley Bank in 2023. Payment system failures. If digital payment systems fail, commerce stops. This happened briefly in various countries during technical glitches. Imagine waking up and your credit cards don't work. ATMs don't work. Online payments don't work. Economy freezes. Loss of reserve currency status. If the dollar lost reserve status, the US would face inflation as dollars held abroad flood back, higher interest rates, lower standard of living, economic adjustment period, similar to what Britain faced when the pound lost reserve status in the mid-20th century. The money system is resilient but fragile. It works through trust and stability. When trust breaks or stability fails, the system can collapse faster than anyone expects. And when the money system breaks, everything else breaks too. Part 6, Money and You, Chapter 31. Why financial literacy should be taught in schools, but isn't. Here's a weird fact. Most schools teach you algebra, Shakespeare, and the Krebs cycle, but not how credit cards work, how to file taxes, or what a 401k is. You graduate high school able to analyze poetry, but not able to understand a mortgage. This is absurd. Why don't schools teach financial literacy? Curriculum inertia. Schools teach what they've always taught. Adding new subjects is hard, removing old subjects is harder. Teacher training. Most teachers don't have financial backgrounds. Who would teach financial literacy? Political issues. Money is political. Teaching about taxes, debt, investing inevitably involves political questions. Schools avoid controversy. It's boring. Let's be honest, compound interest and tax brackets aren't as exciting as literature or science experiments. Corporate interests. Some argue that keeping people financially illiterate benefits credit card companies, banks, and lenders who profit from people's mistakes. But the cost of financial illiteracy is enormous. Personal costs, credit card debt at 20% plus interest, payday loans at 400%, APR, not understanding retirement savings, falling for scams and predatory lending, poor investment decisions, inability to build wealth, social costs, poverty perpetuation, retirement crisis, financial stress causing health problems, economic instability from consumer debt, wealth inequality financially. Literate people build wealth, others don't. What should financial literacy education include? Basics, how bank accounts work, how credit cards work, how to create a budget, understanding debt and interest, how to file taxes, basics of investing, intermediate, different types of insurance, how mortgages work, student loan management, retirement planning, understanding the stock market, credit scores, advanced, tax strategy, estate planning, different investment vehicles, how to evaluate financial advice, understanding economic indicators. Some states have added financial literacy requirements. Results are mixed. Students often forget the information unless they use it immediately. The best time to learn about credit cards is when you're about to get one. The best time to learn about mortgages is when you're buying a house. This suggests financial literacy should be taught multiple times: high school, college, adult education. Taught when relevant, just-in-time learning, practical and applicable, updated regularly, financial system changes. But even without schools, you can educate yourself. Books, websites, courses, YouTube videos, information is available. The question is whether you prioritize learning it. Most people don't until they're already in financial trouble. Chapter 32. The real cost of not understanding money. Let's quantify what financial illiteracy costs you personally. Example 1. Credit card debt. You carry $5,000 in credit card debt at 20% APR. You pay the minimum payment, $100 per month. Time to pay off, 94 months, nearly 8 years. Total interest paid, $4,311. You paid almost as much in interest as the original debt. If you understood how compound interest works against you, you'd prioritize paying this off aggressively. Example 2. Not starting retirement savings early, person A starts saving $200 per month at age 25. Person B starts at age 35. Both invest until 65, 30 years for A, 30 years for B. 30 years for A, 20 years for B. Assuming 7% annual return. Person A, approximately $244,000. Person B, approximately $104,000. Person A contributed $96,000. Person B contributed $72,000. But person A ends with $140,000 more because of compound interest over extra 10 years. The cost of not understanding that starting early matters, $140,000. Example 3, paying too much in fees, investing $10,000 per year for 30 years at 7% return, with 0.1% annual fee, low-cost index fund, approximately $944,000, with 1% annual fee, actively managed fund, approximately $811,000. The 0.9% difference in fees costs you $133,000 over 30 years. Most people don't pay attention to fees. Financial advisors love this. Example 4, falling for payday loans. You need $500 for an emergency. You take a payday loan at 400% APR for 2 weeks. Fee, $75 for 2 weeks. If you can't pay it back, most can, you roll it over. After a year of rolling over, you've paid $1,950 in fees on a $500 loan. Understanding alternatives. Credit union loans, negotiating with creditors' payment plans could save you $1,450. Example 5. Not negotiating salary. You accept a job offer at $60,000 without negotiating. If you'd negotiated, you might have gotten $65,000. Over a 40-year career with 3% annual raises. Starting at $60,000, total earnings approximately $4.5 million. Starting at $65,000, total earnings approximately $4.9 million. Not negotiating cost you $400,000 over your career. These examples show that financial illiteracy has real, quantifiable costs. We're not talking small amounts. We're talking hundreds of thousands of dollars over a lifetime. And this doesn't even count stress and health costs from financial problems, opportunities missed due to lack of capital, inability to retire when you want, passing on financial illiteracy to your children. Chapter 33, How to Actually Build Wealth, The Boring Truth. Get-rich-quick schemes are everywhere. Day trading, cryptocurrency, real estate flipping, dropshipping, NFTs, everyone promises you can get rich fast. Here's the truth. Most people who get rich do it slowly through boring, unsexy methods. Step 1, spend less than you earn. Obvious but often ignored. If you spend everything, or more than everything, you can't build wealth. The gap between income and spending is what becomes wealth. Some people earn $30,000 and save $5,000. Others earn $200,000 and save nothing. The first person is building wealth. The second isn't. Step 2, invest the difference. Saving in a savings account means your money loses value to inflation. Investing means your money grows. The simplest, most proven method, low-cost index funds. Buy a fund that tracks the entire stock market. Hold it for decades. Don't try to time the market or pick individual stocks. Historical returns, approximately 10% annually. Some years up 30%, some years down 30%, but over decades it averages approximately 10%. Step 3, do this for a long time. Compound interest is slow initially, then explosive. $500 per month invested at 10% return. After 10 years, approximately $102,000. After 20 years, approximately $380,000. After 30 years, approximately $1,130,000. Most of the growth happens in later years. Year 30 alone adds more than the entire first decade. This requires patience. You won't see dramatic results for years, but if you stick with it, it works. Step 4. Avoid catastrophic mistakes. Getting rich slow is easy. Staying rich is about not losing it. Catastrophic mistakes to avoid. High-interest debt, credit cards, payday loans. Gambling/speculation with money you can't afford to lose. Not having emergency fund leads to forced bad decisions. Lifestyle inflation, spending more as you earn more. Trying to time the market, paying high fees to active managers. Emotional investing, panic selling in crashes. Step 5. Increase earnings. Saving 20% of $30,000 is $6,000. Saving 20% of $100,000 is $20,000. Increasing income amplifies wealth building. Methods. Develop valuable skills. Negotiate salary. Change jobs. Fastest way to increase salary. Side income. Start a business. That's it. That's the whole strategy. It's not exciting. It won't make you rich next year, but it works. The people selling you get-rich-quick schemes are the ones getting rich from selling you the scheme. Chapter 34. The biggest financial mistakes people make. Let's catalog common financial errors so you can avoid them. Mistake 1. Living paycheck to paycheck by choice. Some people have to live paycheck to paycheck. They genuinely don't earn enough. But many people earning good incomes also live this way by spending everything. If you're earning $75,000 and still have no savings, the problem isn't income, it's spending. Mistake 2. Buying a car you can't afford. The rule: if you can't pay cash, you probably can't afford it. If you must finance, keep payments under 10% of gross income. People buy $50,000 cars on $60,000 salaries with 7-year loans. This is Financial suicide. Cars depreciate. They're terrible investments. Buy reliable, affordable cars. Drive them until they die. Mistake 3. Not having an emergency fund. Unexpected expenses happen. Car repair, medical bills, job loss. Without emergency savings, you're forced into high-interest debt. Rule: save 3 to 6 months of expenses. Keep it in a savings account, accessible but separate from checking. Mistake 4. Trying to keep up with others. Your friends buy a house, you feel you need to buy a house. They vacation in Europe, you book a trip you can't afford. This is called keeping up with the Joneses. And it's a trap. You don't know their financial situation. They might be drowning in debt. Live according to your actual financial situation, not others' apparent situation. Mistake 5. Ignoring retirement because it's far away. I'll start saving when I earn more. Then you earn more, but lifestyle inflates, so you still don't save. Start saving for retirement immediately, even if it's small amounts. Time matters more than amount early on. Mistake 6. Paying the minimum on debt. Minimum payments are designed to keep you in debt as long as possible, maximizing interest paid. Pay more than the minimum. Target highest interest debt first. Get out of debt aggressively. Mistake 7. Not understanding compound interest. Compound interest works for you, investments, and against you, debt. Most people underestimate its power in both directions. Small differences in interest rates or time create massive differences in outcomes. Mistake 8. Mixing up income and wealth. High income doesn't mean wealthy. Doctors and lawyers often have high income but low wealth. They spend it all. Wealth is accumulated assets, not income. Focus on wealth, not looking wealthy. Mistake 9. Following the crowd in investing. When everyone's buying stocks, prices are high. Bad time to buy. When everyone's panicking, prices are low. Good time to buy. But most people do the opposite. Buy high, sell low. This guarantees losses. Mistake 10. Not getting educated. Personal finance isn't complicated, but it requires basic knowledge. Most people never learn the basics. Read books, take courses, listen to podcasts. A few hours of education can save or make you hundreds of thousands of dollars. Mistake 11. Trusting the wrong people. Financial advisors, salespeople, and media personalities often have conflicts of interest. They profit from your decisions. Educate yourself enough to evaluate advice skeptically. Chapter 35. Money and happiness. Does more money make you happier? This is the eternal question. Does money buy happiness? The research shows kind of, but not really, but also yes, but it's complicated. Below approximately $75,000 per year, adjusted for location and inflation, more money absolutely increases happiness. Why? Because you're moving from struggling to pay bills to financial security, from stress about rent to being able to afford emergencies, from choosing between food and medicine to having both. Above approximately $75,000, more money has diminishing returns on happiness. Going from $75,000 to $150,000 increases happiness, but not as much as going from $30,000 to $75,000. Going from $150,000 to $300,000 increases it even less. Going from $300,000 to $1 million, barely noticeable. Why diminishing returns? Once you can afford basics plus some comfort and security, additional money buys, bigger house, adapts quickly, baseline resets, nicer car, same, fancier vacations, memorable but temporary, status goods, social comparison creates treadmill. These don't create lasting happiness. Hedonic adaptation means you get used to any lifestyle level. What does increase happiness? Research consistently finds experiences over possessions, time over money, beyond a point, relationships and social connections, health, autonomy and control over your life, meaningful work, helping others. Money enables these indirectly. With financial security, you can afford experiences, work less or choose work you enjoy, maintain health, help others, reduce stress that damages relationships. But money itself isn't the source of happiness, it's a tool that removes obstacles to happiness. The money-happiness paradox. People think money will make them happy. They sacrifice time, health, and relationships to earn more. Then they're unhappy despite having money. The optimal strategy seems to be 1. Earn enough for security and basic comfort, $75,000-ish, location adjusted. 2. Beyond that, optimize for time, autonomy, relationships, and meaning. 3. Don't sacrifice what actually creates happiness, relationships, health, for money. 4. Use money intentionally for experiences and helping others. Studies show that people who spend money on others are happier than those who spend on themselves. Experiences create more lasting happiness than possessions. The richest people aren't always the happiest. But being poor is strongly correlated with unhappiness, from stress, insecurity, and inability to meet basic needs. The conclusion: money up to a point is crucial for happiness. Beyond that point, how you use money matters more than how much you have. Chapter 36. Teaching your kids about money. If you have children, you'll probably want them to be financially literate. Here's how to actually teach them. Ages 3 to 5. Basic concepts. Money is exchanged for things. Different coins/bills have different values. You need to earn money. Saving means waiting activities. Play store. Save coins in a jar. Earn money for simple tasks. Ages 6 to 10. Earning and saving. Allowance. Teach budgeting. Earning money through chores. Saving for goals. Needs versus wants. Basic math of money. Addition, subtraction, multiplication for calculating totals. Activities. Create savings goals. Match savings for big purchases. Open a savings account. Ages 11 to 13. Banking and value. How banks work. Interest. Earning and paying. Comparison shopping. Opportunity cost. Budgeting activities. Let them manage their own money with guidance. Discuss family financial decisions. Show them how to research purchases. Ages 14 to 18. Advanced concepts. How credit works. Investing basics. Taxes. Career and income. Student loans and college costs. Getting a job. Activities. Open investment account. Custodial. Practice filing taxes even if not required. Discuss college financing realistically. Key principles. Make it real. Use real money, real purchases, real consequences. Monopoly money doesn't teach real lessons. Let them make mistakes. If they blow their money on something dumb, let them. The lesson costs $20 now instead of $20,000 later. Model good behavior. Your kids watch what you do more than they listen to what you say. If you're financially irresponsible, they'll probably be too. Don't hide money. Completely. Some parents never discuss money with kids. This leaves them unprepared for adult financial decisions. But don't overshare problems. Kids shouldn't bear adult financial stress. There's a balance between transparency and burdening them. Teach earning, not just spending. Kids who only learn to spend money become adults who only know how to spend money. Teach them how money is earned. Connect money to values. What do we spend on? Why? What do we not spend on? Why? Money reflects values. Be age appropriate. 5-year-olds don't need to understand compound interest. 17-year-olds heading to college do. The goal isn't to make them obsessed with money. It's to give them tools to make good financial decisions so money doesn't control their lives. Part 7. The Psychology and Philosophy of Money. Chapter 37. Why we're irrational about money. Humans are terrible at thinking rationally about money. Our brains evolved to survive on the African savanna, not to optimize investment portfolios. This creates predictable biases. Loss aversion. Losing $100 hurts about twice as much as gaining $100 feels good. This makes us overly cautious with investments and overly aggressive about avoiding losses. You'll hold on to a losing stock because selling means realizing the loss. You'll pass up good investments because you're afraid of potential losses. Mental accounting. We treat money differently based on where it came from. Tax refund, splurge money, paycheck, serious money, birthday gift, fun money, but it's all the same money. $100 is $100 regardless of source. Anchoring. The first number we see becomes the reference point. Car originally $30,000, on sale for $25,000. Seems like a deal, even if it's only worth $20,000. Your brain anchors to $30,000 and perceives $5,000 savings, ignoring actual value. Present bias. We heavily discount future rewards. $100 today feels more valuable than $110 in a month, even though waiting is objectively better. 10% return in 1 month is insane. This is why retirement savings is hard. The reward is decades away. The sacrifice is now. Present bias makes this feel like a bad trade even when it's not. Sunk cost fallacy. We continue bad investments because we've already invested so much. I've already spent $2,000 repairing this car. I can't give up now. Rational behavior. Ignore sunk costs. Evaluate whether additional investment is worth it based on future value alone, but we can't ignore sunk costs. It feels like wasting the previous investment. Herd mentality. We follow the crowd. Everyone's buying stocks, must be a good time to buy. Everyone's panicking, must be time to sell. This creates bubbles. Everyone buying drives prices up and crashes. Everyone selling drives prices down. Rational investors do the opposite. Buy when others panic, sell when others are euphoric. Almost nobody does this. Overconfidence. We think we're better at investing than we are. 70% of drivers think they're above average drivers. Mathematically impossible. Similarly, most investors think they can beat the market. Almost none do. Recency bias. Recent events disproportionately influence our thinking. Market crashed last month? We think it'll crash again. Market's been rising? We think it'll keep rising. Neither is true. Markets don't have memory. Past performance doesn't predict future results. The endowment effect. We value things more once we own them. You wouldn't pay $300 for a concert ticket, but if you own a $300 ticket, you wouldn't sell it for $300. Your ownership changes your valuation. This makes selling investments harder than it should be. Confirmation bias. We seek information confirming our existing beliefs. You bought a stock. Now you only read articles saying it's good. You ignore warnings. This prevents you from changing your mind when evidence suggests you're wrong. Understanding these biases doesn't eliminate them. Your brain still does this, but awareness helps you recognize when you're being irrational and potentially override it. Chapter 38. What money actually represents. Let's get philosophical. What is money, really? At the deepest level, money represents stored labor. When you work, you exchange your time and effort for money. Money is your labor in portable, storable form. You worked 40 hours. You got $2,000. That $2,000 represents 40 hours of your life. When you spend it, you're exchanging those 40 hours for whatever you buy. Claim on resources. Money is a claim on society's productive capacity. Your $2,000 lets you claim $2,000 worth of goods and services that other people produced. The more money you have, the more claim you have on others' labor. Social trust. Money only works because we all trust it will be accepted. A dollar bill is paper. It has value only because everyone believes it has value. This is why counterfeiting is serious. It undermines trust in the currency. Power. Money is power over resources, over other people's labor, over your own time and choices. Wealthy people have more power than poor people, not officially, but practically. Freedom. Money buys choices. The choice to quit a bad job. The choice to move. The choice to say no. Lack of money removes choices. You take whatever job pays. You stay where housing is cheapest. You can't say no. Security. Money is buffer against disaster. Emergency fund, insurance, savings. These are security. Without money, every problem becomes a crisis. Car breaks, crisis. Medical bill, crisis. Lose job, crisis. With money, problems are just problems. Manageable, not catastrophic. Social relation. Money creates relationships between people. Debt creates relationship between lender and borrower. Investment creates relationship between investor and company. Taxes create relationship between citizen and state. These relationships define society's structure. Measurement. Money lets us measure value, compare options, calculate trade-offs. Without money, how do you compare the value of a car to a year of college? Money makes them comparable. Time. Money is frozen time. You spent time earning it. It preserves that time until you're ready to spend it. Saving money is saving time. Past time to use in the future. When you understand what money represents, you realize it's not the end goal. It's a tool that represents labor, time, security, freedom, power. Pursuing money makes sense when you need security and freedom. Pursuing money beyond that point is pursuing a tool when you should be pursuing the goals the tool enables. Chapter 39. The Ethics of Wealth. Is it ethical to be wealthy when others are poor? This question has occupied philosophers, theologians, and economists for millennia. The libertarian view, you earned it. It's yours. You have no obligation to share it. Taxation is theft. Forced redistribution is immoral. Voluntary charity is fine, but compulsion is wrong. Your wealth came from voluntary transactions. Nobody was forced to buy what you sold or work for your company. Therefore, you deserve it. The utilitarian view. Wealth should be distributed to maximize overall happiness. A dollar means more to a poor person than a rich person, diminishing marginal utility. Therefore, transferring wealth from rich to poor increases total happiness. Extreme wealth inequality reduces overall well-being. Redistribution through taxes and social programs is ethical. The religious view varies by religion, but generally, most religions emphasize helping the poor. Easier for a camel to go through the eye of a needle than for a rich man to enter heaven. Wealth is a blessing, but comes with responsibility. Hoarding wealth is sinful. Charity is obligatory. Islam has zakat, mandatory charitable giving of 2.5% of wealth. Christianity emphasizes helping the poor. Buddhism teaches non-attachment to material wealth. The meritocratic view, people should get what they earn through effort and skill. Inequality is acceptable if it reflects different levels of contribution. Unequal outcomes are fine if everyone had equal opportunity. The problem, opportunity isn't equal. Inherited wealth, education access, connections, these create unequal starting points. The social contract view. Wealth creation requires social infrastructure. You didn't build that business alone. You used roads built by taxes, education funded by taxes, legal system enforcing contracts, currency managed by government, workers educated in public schools. Therefore, wealthy people owe society for enabling their wealth. Taxes aren't theft. They're payment for services received. The practical view, extreme inequality is socially destabilizing. Throughout history, extreme inequality led to revolutions, social unrest, political extremism. For purely practical reasons, preserving social order, some redistribution is necessary. My take, you can disagree. Some inequality is natural and healthy. People have different skills, work ethics, and risk tolerances. Rewarding these differences incentivizes productive behavior, but extreme inequality, billionaires while others lack health care, is both unjust and practically harmful. Wealth beyond a certain point provides minimal additional happiness, but could dramatically improve many lives if redistributed. The ethical position seems to be earn wealth through value creation, not extraction or exploitation. Pay your fair share in taxes. Use wealth to improve others' lives. Don't hoard beyond what you need for security and comfort. Ensure opportunity is available to others, but reasonable people disagree on specifics. Chapter 40. Money and Meaning. Can money buy a meaningful life? Can money buy meaning? No. Can it buy the freedom to pursue meaning? Yes. Let's break this down. What creates meaning? Research and philosophy suggest meaning comes from relationships and love, contributing to something larger than yourself, personal growth and achievement, creating or experiencing beauty, understanding and wisdom, helping others, living according to values. Notice, none of these require money, but many require freedom from financial stress, which requires money. How money enables meaning. Time. Money buys time by reducing hours you must work. With time, you can pursue relationships, hobbies, learning, creation. Autonomy. Money lets you choose work aligned with your values rather than taking whatever pays the bills. Capability. Want to create art, need supplies, want to learn, need books or courses, want to help others, resources help, experiences, travel, concerts, events, experiences that create memories and growth cost money. Security. Hard to focus on meaning when worried about rent. Maslow's hierarchy. Basic needs first, then self-actualization. How money undermines meaning. Substitution. Pursuing money instead of meaning. Spending life making money you'll never spend. Comparison. Money enables social comparison. He has more than me creates dissatisfaction regardless of absolute wealth. Corruption. Money can corrupt values. Doing immoral things for money. Prioritizing profit over principles. Distraction. Shopping, acquiring, maintaining possessions. These distract from meaningful pursuits. Isolation. Extreme wealth can isolate you from normal human relationships. Everyone wants something from you. The paradox. Money is most valuable when you have just enough. Too little. constant stress, no time/energy for meaning, just enough, security and freedom to pursue meaning. Too much. Money becomes its own goal, distraction, or burden. The optimal amount seems to be enough for security, some comfort and experiences, but not so much that much. Money itself becomes the focus. Stories from the wealthy. Many wealthy people report that achievement of wealth was satisfying, but possession of wealth is empty. The pursuit was meaningful, building a company, creating value, solving problems. The result, being rich, didn't provide expected satisfaction. Some find meaning in philanthropy, using wealth to help others. Others find meaning in continued work despite not needing money. Almost none find meaning in consumption, buying more stuff, bigger houses, fancier cars. The research agrees. Above approximately $75,000 to $100,000 per year, adjusted for location, additional money has minimal impact on happiness or meaning. The conclusion: money can't buy meaning directly, but it can buy the preconditions for pursuing meaning: security, time, freedom. Use money as a tool for creating meaningful life. Don't use life as a tool for creating money. Chapter 41: The Future of Work and Money. Work and money are interconnected. How we work determines how we earn. Changes in work mean changes in money. Several trends are reshaping this relationship. Automation and AI. Increasingly, machines can do what humans do. Self-checkout eliminates cashiers. Self-driving cars will eliminate drivers. AI is automating white-collar work, writing, analysis, coding. What happens when we don't need human workers? Optimistic view: humans do more valuable work. We automated agriculture, used to employ 90% of people, now less than 2%, and found new jobs. Pessimistic view: this time is different. AI can do cognitive work. There's no next level for most humans to move to. Middle view: transition period will be painful. Eventually we'll adapt, but many will suffer during adjustment. Gig economy: traditional employment, one employer, steady paycheck, benefits, is declining. Replaced by contract work, freelancing, gig work, side hustles. Benefits: flexibility, autonomy, multiple income streams. Downsides: no benefits, no security, inconsistent income, isolation. This changes how we think about money, from steady paycheck to variable income requiring different budgeting and saving strategies. Remote work. COVID accelerated remote work. Many jobs don't require physical presence. This changes geography of earnings. You can earn San Francisco salary while living in low-cost area, but also enables companies to hire globally, potentially reducing wages through global competition. Universal basic income. As work becomes less available or reliable, UBI becomes more discussed. If machines do most work, how do humans earn money? UBI provides baseline income regardless of employment. Proponents say it's necessary. Critics say it's unaffordable and undermines work ethic. Shorter work weeks. Some countries experimenting with 4-day work weeks or 6-hour days. Productivity remains similar. Workers are happier and healthier. If machines do routine work, humans might work less while maintaining living standards. Multiple careers. Previous generations worked one career. Current generation averages 5 to 7 career changes. This requires continuous learning, adaptability, and financial resilience, since career changes often involve income fluctuations. Creator economy. Internet enables individuals to monetize skills and attention directly. YouTubers, streamers, writers, artists, educators, people earning income by creating content. This democratizes income, but creates winner-take-all dynamics. Top creators earn millions, most earn nothing. What this means for money: traditional financial planning assumed, steady career progression, increasing salary over time, employer benefits, retirement at 65. New reality: variable income, self-funded benefits, multiple career transitions, uncertain retirement age. Financial strategies must adapt. Larger emergency funds, 6 to 12 months instead of 3 to 6. Diversified income streams, portable benefits, not tied to employer. Continuous skill development, more conservative retirement planning. The relationship between work and money is being fundamentally restructured. Understanding these changes is crucial for financial planning. Part 8. Taking Control. Chapter 42. Creating Your Money. Philosophy. You need a conscious philosophy about money. Without one, you'll unconsciously adopt society's philosophy. More is always better. Consumption equals happiness. Questions to answer for yourself. What is money for? Security, freedom, experiences, helping others, status, power. Your answer shapes everything else. If money is for security, you'll prioritize savings and insurance. If it's for freedom, you'll prioritize reducing expenses and building passive income. If it's for experiences, you'll spend on travel and activities while minimizing possessions. How much is enough? Without a target, you'll always want more. Enough keeps moving. Calculate what annual expenses would fund the life you actually want. Multiply by 25. That's your enough number. $40,000 per year expenses equals $1 million is enough. Beyond that, you're not pursuing security. You're pursuing something else. Make sure it's intentional. What are you willing to sacrifice? Money requires trade-offs, time for money, freedom for money, health for money, relationships for money. What trade-offs are acceptable? What are non-negotiable? Some people sacrifice family time for career advancement. Others refuse this trade-off at any price. Neither is wrong, but it should be conscious choice, not default. What do you value spending on? Not everything costs the same per unit of happiness. For me, experiences greater than relationships, greater than learning, greater than possessions. For you, might be different. Spend generously on things you value. Cut ruthlessly on things you don't. Society tells you to spend on houses, cars, designer clothes. Maybe those don't actually matter to you. What's your relationship with risk? Risk-averse, prioritize stable income, guaranteed returns, insurance, emergency funds. Risk-tolerant, comfortable with variable income, volatile investments, less insurance, smaller emergency funds. Neither is wrong, but your financial strategy should match your temperament. What's your time horizon? Optimizing for next year, next decade, rest of your life, future generations? This affects every decision. Short horizon, maximize current income and consumption. Long horizon, maximize long-term wealth and legacy. How important is money relative to other values? Is maximizing money your primary goal, or is it a tool that supports other goals? This determines career choices, where you live, how much you work. Write it down. Seriously, write out your money philosophy. Refer to it when making financial decisions. Does this purchase align with my values? Does this job align with my philosophy? Does this investment match my risk tolerance? Without explicit philosophy, you'll make inconsistent decisions based on emotions, social pressure, and marketing. With explicit philosophy, you have a framework for decision making. Chapter 43, The Practical Steps, What to Actually Do Enough Theory. Here's the practical action plan. Step 1, know your numbers. Track spending for 1 month. Every dollar. No judgment, just data. Most people have no idea where money goes. Tracking reveals it. Calculate monthly income after tax, monthly expenses by category, net worth, assets minus debts. Step 2, build emergency fund. Save $1,000 immediately if you have nothing. This covers small emergencies. Then save 3 to 6 months of expenses. This covers job loss or major emergency. Keep it in a high-yield savings account, accessible but separate from checking. Step 3, eliminate high-interest debt. Anything above 7 to 8% interest should be paid off aggressively. Credit cards, 15 to 25%. Payday loans, 400% plus. Title loans, these are wealth. Destroyers, pay minimum on everything except highest interest debt. Attack that with all available money. When it's gone, move to next highest interest debt. Repeat. Step 4, get the employer 401k match. If your employer matches contributions to retirement account, contribute at least enough to get full match. This is free money, 100% instant return. No investment beats this. Step 5, pay off moderate interest debt, 4 to 7% interest debt, some student loans, car loans. Pay these off before investing heavily. Guaranteed 4 to 7% return from saving interest versus uncertain stock market returns. Step 6, max tax-advantaged retirement accounts. After high/moderate debt is gone, an emergency fund is built. Contribute to 401k up to max, $23,000 in 2024, IRA, $7,000 in 2024, HSA if you have high deductible health plan, $4,150 individual, $8,300 family in 2024. These accounts grow tax-free or tax-deferred. Huge advantage over taxable accounts. Step 7. Invest in Low-cost index funds. Within your retirement accounts, invest in total stock market index fund like VTSAX, FSKAX, or target date retirement fund. Automatically adjusts allocation as you age. Don't pick individual stocks. Don't try to time the market. Don't pay for active management. Just buy the whole market and hold forever. Step 8. Additional investments in taxable accounts. After maxing tax-advantaged accounts, invest in regular taxable accounts. Same strategy. Low-cost index funds. Step 9. Consider real estate buying home makes sense if you'll stay 5+ years. Mortgage payment less than or equal to rent for equivalent home. You can afford 20% down payment. You have stable income. It doesn't make sense as investment. It's lifestyle choice that happens to build equity. Rental real estate is different, actual investment, but requires work and knowledge. Step 10. Increase income. Most important long-term strategy. Saving 20% of $50,000 is $10,000 per year. Saving 20% of $100,000 is $20,000 per year. Doubling income doubles savings without reducing spending. Methods. Develop valuable skills. Switch jobs, usually biggest raises. Negotiate salary. Side income. Start business. Step 11. Optimize taxes. Legal tax reduction strategies. Max retirement contributions. Reduces taxable income. HSA contributions. Tax loss harvesting in taxable accounts. Donate appreciated stock instead of cash. Time income/deductions strategically. Consider tax professional if income is complex or high. Step 12. Protect with insurance. Health insurance required. Life insurance if others depend on your income. Disability insurance. Protect income if you can't work. Homeowners/renters insurance. Car insurance. Umbrella liability if significant assets. Skip. Extended warranties. Most insurance salesmen push. Step 13. Estate planning. Will directs asset distribution. Beneficiaries on all accounts. Healthcare directive. Medical decisions if incapacitated. Power of attorney. Financial decisions if incapacitated. Trust if assets above estate tax threshold or complex situation. Step 14. Review and adjust annually. Life changes. Review everything yearly. Is budget still accurate? Are investments allocated correctly? Are insurance needs different? Have goals changed? Adjust as needed. This plan isn't sexy. It's boring and slow, but it works. Follow it for decades and you'll be financially secure, probably wealthy, and definitely better off than 90% of people. Chapter 44. Common questions answered. Q. Should I pay off mortgage early or invest? A. Depends on mortgage rate and your risk tolerance. Mortgage under 4%. Invest instead. Expected stock returns approximately 10%. Exceed mortgage rate. Mortgage over 6%. Pay off early. Guaranteed return exceeds likely investment returns. Between 4 to 6%. Personal preference. Pay off if you value security and debt freedom. Invest if you're comfortable with risk and want higher potential returns. Q. How much should I have saved by age X? A. General guidelines. Age 30, 1 times annual salary. Age 40, 3 times annual salary. Age 50, 6 times annual salary. Age 60, 8 times annual salary. Age 67, retirement, 10 times annual salary. These are guidelines, not rules. Your situation may differ. Q. Should I use a financial advisor? A. For most people, no. The plan above is sufficient. Consider advisor if very high income/wealth, complex tax situation, business owner, business succession, tax strategy, inheritance/windfall, need help managing. You absolutely won't do it yourself. If you hire one, fee only, not commission-based. Fiduciary, legally required to act in your interest. Low fees, under 1%. Q. What about crypto? A. Speculative gamble, not investment. If you want to gamble, max 5% of portfolio in crypto. Don't expect it to replace traditional investing. Q. Should I invest in individual stocks? A. No, unless you have significant knowledge/experience, you're willing to research extensively, you accept you'll probably underperform index funds, you enjoy it as a hobby, not relying on returns. For 99% of people, Index funds beat individual stocks. Q. How do I invest in index funds? A. Open account at Vanguard, Fidelity, or Schwab. Buy VTI or VTSAX, Vanguard Total Stock Market, FSKAX, Fidelity Total Market, SWTSX, Schwab Total Stock Market, or buy target date fund for your expected retirement year. Q. What if market crashes after I invest? A. Keep investing. Dollar cost averaging means you buy more shares when prices are low. Market crashes are sales, everything on discount. Never panic sell. Market always recovers eventually. Q. Should I buy or rent? A. Buy if staying 5+ years, payment less than or equal to rent, 20% down saved, stable income, want permanence. Rent if moving soon, prices much higher than rent, unstable income, value flexibility. Neither is inherently better. Context matters. Q. How do I start if I'm already behind? A. Start now. Better to start at 40 than at 50. Better to start at 50 than never. Can't save much? Save something. $50 per month is better than $0. Focus on what you can control. Reduce expenses, increase income, invest what you can. Late start means you need higher savings rate, but it's still possible. Q. What if I make mistakes? A. You will. Everyone does. Learn from them. Don't repeat them. Move forward. Financial mistakes early, when amounts are small, are cheaper lessons than mistakes later, when amounts are large. Chapter 45. The money mistakes that haunt people for decades. Let's talk about the financial decisions that seem small at the time but compound into life-altering regrets. The student loan catastrophe. Taking $100,000 in student loans for a degree that leads to a $35,000 per year job is a mistake that follows you for 20+ years. The math is brutal. Minus $100,000 at 6% interest over 20 years equals $716 per month payment. Total paid, $172,000. On $35,000 salary, $716 per month is 25% of gross income. This destroys your 20s and 30s. Can't buy a house, debt to income ratio too high. Can't save for retirement, can't build wealth, can't take career risks. The correction: choose schools and majors based on ROI, not prestige or passion alone. State schools over private, in-demand fields over interesting ones. $30,000 total debt over $100,000. Or don't go to college at all. Trade schools, coding boot camps, entrepreneurship are often better financial decisions. The lifestyle inflation trap. You get a raise from $50,000 to $70,000. Instead of saving the extra $20,000, you upgrade everything. Nicer apartment, plus $500 per month. Newer car, plus $400 per month. Better restaurants, plus $300 per month. More shopping, plus $300 per month. Suddenly, you're still living paycheck to paycheck, despite earning 40% more. Then you get used to this lifestyle. Going back feels like deprivation. You're trapped. The insidious part, each upgrade seems reasonable in isolation, but collectively, they consume all income growth. The correction: when income increases, increase savings rate, not spending rate. Live on $50,000 when earning $70,000. Save or invest the difference. The "I'll start saving when" delusion. I'll start saving when I pay off my car. I'll start saving when I get my next raise. I'll start saving when the kids are older. I'll start saving when I'm more established in my career. This is always a lie. There's always a reason to wait. Meanwhile, time passes. The most powerful factor in wealth building, time, is lost forever. Starting at 25 versus 35 isn't a 10-year difference. Because of compound interest, it's closer to a 50% difference in final wealth. The correction: start now. Even $50 per month. Establish the habit. The amount matters less than the consistency early on. The too good to be true investment. Someone promises 20% guaranteed returns, or a can't miss business opportunity, or a sure thing in crypto/stocks/real estate. You invest money you can't afford to lose. It's a scam or it fails. The money is gone. This happens to smart people. Greed and FOMO, fear of missing out, override skepticism. Bernie Madoff ran a Ponzi scheme for decades, stealing billions from sophisticated investors. The correction: if it sounds too good to be true, it is. Legitimate investments involve risk and modest returns, 7 to 10% long-term average. Anyone promising better guaranteed returns is lying. The divorce financial apocalypse. Divorce is financially devastating even when amicable. One household becomes two. Fixed costs, housing, utilities, insurance, nearly double while income stays the same. Legal fees, $15,000 to $50,000 average. Asset division, the house you worked 10 years to pay off gets split or sold. Retirement accounts cut in half. Child support or alimony, ongoing financial obligation. The financial impact of divorce often exceeds $100,000 and sets both parties back 5 to 10 years financially. The prevention, choose partner wisely, work on relationship, prenup if significant assets. But sometimes divorce is necessary despite cost. The mitigation, mediation over litigation, collaborative divorce over adversarial, protect retirement accounts if possible. The I'll just work forever. Assumption. Many people don't save for retirement assuming they'll just work until they die. Problems. Your body might not cooperate. Health issues force early retirement. Age discrimination is real. Good luck finding work at 68 if you lose your job. Industries change. Your skills might become obsolete. You might not want to work. Burnout happens. Relying on ability to work is relying on factors beyond your control. The correction. Save as if you won't be able to work past 65. If you can work longer, great, extra cushion. But don't depend on it. The timing the market disaster. 2008, market crashes. You panic and sell everything. 2009 to 2020, market recovers and reaches all-time highs. You missed the entire recovery because you were waiting for the right time to get back in. Or 2020, market crashes due to COVID. You panic sell. Market recovers within months to new highs. You missed it. Timing the market means you have to be right twice. When to sell and when to buy back. Almost nobody gets both right. The math. If you miss the 10 best days in the market over 30 years, your returns drop by 50%. The correction, never sell in a panic. Stay invested through crashes. Keep buying during downturns. Everything on sale. The co-signing nightmare. Your friend/sibling/child needs a loan but can't qualify. You co-sign because you want to help. They default. You're legally responsible for the full amount. Your credit is destroyed. You're being sued. Your wages are garnished. Your relationship with that person is ruined. 30% of co-signers end up paying part or all of the loan. The correction. Never co-sign. If you want to help, give money as a gift if you can afford it. But don't put your financial security at risk for someone else's debt. The I don't need insurance. Gamble. You're young and healthy. You skip health insurance to save money. You get in a car accident, hospital bill, $75,000, you don't have it, medical bankruptcy, or you're the family breadwinner, you don't buy life insurance, you die unexpectedly, your family has no income and loses the house, or you skip disability insurance, you become disabled and can't work, no income, bills pile up, savings depleted. Insurance seems like wasted money until you need it, then it's priceless. The correction, carry appropriate insurance. Health, required by law anyway. Life, if others depend on your income. Disability, protect your earning ability. The premiums are far less than the catastrophic costs they protect against. The car wealth destroyer, buying new cars on loans is one of the most common wealth killers. Example, buy $35,000 car with $5,000 down. Finance $30,000 at 6% for 6 years. Monthly payment, $497. Total paid, $40,754. Car value in 6 years, approximately $12,000. Total cost of owning, $33,754. $5,000 down, plus $40,754 paid minus $12,000 value. That's $33,754 for 6 years of transportation, or $5,625 per year. Alternative, buy reliable used car for $10,000 cash, drive 10 years. Maintenance approximately $1,500 per year. Total cost $25,000 over 10 years, or $2,500 per year. Difference, $3,125 per year. Over 40 years of driving, investing that difference at 8% return creates $900,000 additional wealth. The car you drive is the difference between retiring comfortable or not. The correction, buy reliable used cars with cash, drive them until they die, never have a car payment. Chapter 46, The Uncomfortable Truths About Money. Some truths about money are politically incorrect or emotionally difficult, but they're true nonetheless. Truth number 1, financial success is easier for some people than others. Being born into wealth, with educated parents, in a stable country, with access to good schools, without discrimination, with good health, all of these make financial success easier. This doesn't mean success is impossible without these advantages. Many people overcome difficult circumstances and build wealth, but it does mean we should have humility about our own success. How much was our effort versus our circumstances, and compassion for others' struggles. Maybe they faced barriers we didn't. Truth number 2, most people will never be wealthy. The math doesn't work. Median household income in the US is approximately $75,000. After taxes, expenses, and normal life costs, most people can't save enough to become wealthy. Some will through high income, inheritance, or luck. Most won't. This isn't failure. It's reality. The goal for most people should be financial security, not wealth. Truth number 3, money correlates with but doesn't equal worth. Our society treats wealth as a proxy for value. Rich people must be smart, hardworking, deserving. Poor people must be lazy, stupid, undeserving. This is false. Some wealthy people are brilliant and hardworking. Some are lucky or unethical. Some poor people are lazy. Some are unlucky or victims of circumstance. Net worth doesn't measure human worth. Truth number 4, the system is designed to keep you in debt. Credit card companies, banks, car dealers, student loan servicers, they profit from your debt. They're not evil. They're rational economic actors, but their incentives don't align with yours. The system is designed to make debt easy and savings hard. Marketing encourages consumption. Social pressure creates lifestyle inflation. Understanding this means you're fighting systemic forces, not just making individual choices. Truth number 5, financial advice is often self-serving financial advisors, media personalities, product salespeople. They often give advice that benefits them, not you. The advisor who makes commission selling you products recommends you buy products. The media personality who gets clicks from dramatic predictions makes dramatic predictions. The bank that profits from your debt encourages you to borrow. Always ask, who benefits from this advice? Truth number 6, you probably need less than you think. The retirement calculators say you need $2 million. Financial advisors say you need more, but many people retire comfortably on much less by moving to lower cost areas, downsizing housing, spending less than they expected, finding free or cheap activities, focusing on relationships over consumption. The retirement industry benefits from you being scared and saving more. More assets under management equals more fees. You might need less than they say. Truth number 7, luck matters more than we admit. When you were born, where you were born, who your parents were, your genetics, the economy when you graduated, whether you got sick or injured, who you happened to meet. Luck plays an enormous role in financial outcomes. Successful people attribute their success to hard work and skill, makes them feel good. Unsuccessful people attribute their failure to bad luck and circumstances, makes them feel better. Both are partly right. Success requires both effort and luck. Failure can result from both poor choices and bad circumstances. Truth number 8, money changes relationships. Lending money to family destroys relationships. Unequal wealth among friends creates tension. Inheritance causes sibling conflicts. Marriage involves merging finances and financial values. Money and relationships are inseparable. Pretending otherwise causes problems. Address money openly in relationships. Discuss values, goals, concerns. Don't let money issues fester unsaid. Truth number 9, you can't have it all. Every financial choice is a trade-off. Money spent here can't be spent there. Time spent earning can't be spent with family. Risk taken for potential gain includes potential loss. The myth of having it all creates anxiety and disappointment. You can have a lot, but not everything simultaneously. Choose consciously. Accept trade-offs. Don't torture yourself about roads not taken. Truth number 10, most financial drama is self-inflicted. Spending more than you earn. taking on debt for consumption, not saving for emergencies, trying to impress others, keeping up with neighbors. These are choices. Unfortunate, often unconscious, heavily influenced by society and psychology, but still choices. Taking responsibility doesn't mean blaming yourself. It means recognizing where you have control and using it. Chapter 47, Money Across Generations. How financial wisdom, or lack thereof, passes down. Your relationship with money didn't start with you. It started with your grandparents, maybe earlier. The Depression generation, born 1910s to 1920s, grew up in or lived through the Great Depression, saw 25% unemployment, saw neighbors lose everything, learned money could disappear overnight, financial values, save everything, waste nothing, don't trust banks, they failed during Depression, don't trust stocks, 1929 crash, value security over growth, they saved obsessively, sometimes counterproductively, keeping cash instead of investing, missing growth opportunities. The silent generation, born 1930s to 1940s, benefited from post-World War II boom. Strong unions, rising wages, pensions, stable employment. Houses were affordable. College was cheap. One income could support a family. Financial values, work hard, company takes care of you, loyalty to employer, pensions provide retirement, Social Security is reliable. This generation had easier path to middle-class security than any before or since. Baby boomers, born 1946 to 1964, entered workforce during economic expansion, benefited from rising real estate, strong stock market, generous pensions, early boomers, and increasing prosperity. Financial values, real. Estate always goes up. Stocks for long-term growth. You can have it all. Career, family, nice house, comfortable retirement. Later, boomers faced more challenges, stagflation in 70s, recessions in 80s to 90s, but generally built wealth through real estate and stocks. Generation X, born 1965 to 1980, entered workforce during recession, early 90s, or dot-com boom, late 90s, saw pensions disappear, replaced by 401s, Ks, shifting risk from employers to employees, experienced dot-com crash in 2008 financial crisis, financial values, don't trust employers, save for yourself, diversify, be skeptical of get-rich-quick schemes, work-life balance matters, more financially savvy than boomers, but faced more challenging environment. Millennials, born 1981 to 1996, entered workforce during slash after 2008 financial crisis, faced high student debt, stagnant wages, expensive housing, gig economy, multiple recessions, financial values, traditional path, college to job to house to retirement is broken, side hustles necessary, FIRE movement, financial independence, retire early, skeptical of stocks after seeing parents lose money in 2008, interested in alternative investments, crypto, etc. Most financially stressed generation in modern times. Student debt and housing costs created delayed adulthood, later marriage, later home buying, later having kids. Generation Z, born 1997 to 2012, too early to fully characterize, but emerging patterns. Entered workforce during COVID and 2020's inflation. Grew up with gig economy as normal. Saw millennial struggles and may avoid same mistakes, or repeat them. Financial values, still forming. Possibly more practical than millennials, seen their struggles. More likely to skip college or choose practical majors. Interested in entrepreneurship and alternative career paths. How financial wisdom transfers, or doesn't. Each generation learns from the previous generation's experience. Sometimes this wisdom is helpful, sometimes it's outdated. Depression generation taught, don't trust banks or stocks. This helped avoid some losses but also caused them to miss gains. Silent generation taught, work for one company, get pension. This worked for them, but doesn't work now. Pensions are dead. Boomers taught, buy real estate, it always goes up. This worked for them, bought cheap, sold expensive, but created housing affordability crisis for younger generations. Gen X and millennials are teaching, don't rely on employers, build multiple income streams, don't assume traditional path works. The challenge, learning right lessons from previous generation without being trapped by outdated wisdom. What worked in 1960, one income, pension, cheap housing, doesn't work in 2025. What worked in 1990, internet boom, cheap college, 401k doesn't work identically in 2025. Each generation must adapt financial wisdom to current reality, breaking negative patterns. If your parents were bad with money, you have to consciously learn better habits. It's not automatic. If your parents never discussed money, you have to seek financial education elsewhere. If your parents created shame around money, either having too little or having too much, you have to unlearn that psychological baggage. Financial dysfunction passes through generations unless consciously addressed. What to teach the next generation? Money is tool, not measure of worth. Spend less than you earn. Compound interest is powerful for and against you. Debt is dangerous but sometimes useful. Invest in yourself. Education, skills, health. Diversify income sources. Save for uncertainty. Understand taxes, insurance, investing basics. Balance present enjoyment with future security. Money enables choices. Lack of money removes them. Be generous but not foolish. Question societal messages about consumption. Financial security matters more than looking wealthy. The financial wisdom we pass down shapes the next generation's relationship with money. Make sure it's wisdom worth passing down. Conclusion: money is a tool, not a goal. We've covered a lot. Ancient barter systems to cryptocurrency, hyperinflation to compound interest, tax havens to teaching kids about money. Here's what it all comes down to. Money is a tool, an incredibly useful tool. Maybe the most important tool humans ever invented, but it's still just a tool. The goal isn't to have money, the goal is to use money to build the life you want. For some people, that means early retirement and financial independence. For others, it means working forever at something they love while having financial security. For others, it means moderate wealth and lots of time with family. For others, it means extreme wealth and influence. None of these is wrong. The question is, what do you want? Too many people pursue money without asking why. They get rich and realize wealth didn't solve their problems or bring happiness. 2, many others avoid thinking about money entirely. They struggle financially and never achieve security or freedom. The middle path. Understand money well enough to use it effectively as a tool for building the life you actually want. This requires knowledge. Understand how money works. You now have this. Philosophy. Decide what you want money to do for you. Only you can determine this. Discipline. Follow through on your plan. This is the hardest part. Flexibility. Adjust as life changes. No plan survives contact with reality. Balance. Don't let money consume your life, positively or negatively. Remember the basics. Spend less than you earn. Invest the difference in low-cost index funds. Avoid high-interest debt. Build emergency fund. Increase income when possible. Don't try to time the market or pick stocks. Start early, be patient, stay consistent. Use money to buy time and freedom, not just things. Help others when you can. Don't compare your situation to others. Money is means, not end. If you do these things, you'll be fine. Maybe not rich, though probably wealthier than you expect, but financially secure and free from money stress. That's worth more than being rich while stressed, unhappy, and controlled by money. A final thought. Money is one of humanity's greatest inventions and greatest curses. It enables cooperation, trade, progress, and civilization. It also enables inequality, exploitation, stress, and corruption. Like any powerful tool, money amplifies what you already are. It gives good people more capacity for good. It gives bad people more capacity for bad. It gives anxious people more to be anxious about. It gives generous people more to give. The goal isn't to eliminate money or worship it. The goal is to understand it, control it, and use it intentionally. You now understand how money works, from ancient cowrie shells to modern cryptocurrency, from fractional reserve banking to compound interest, from tax havens to retirement planning. What you do with this knowledge is up to you. Use it wisely.